Their core business was a bit more negative, so we'll watch that. On sportswear, we've had the read across from Nike, so we'll keep an eye on Adidas and Puma, so those will be in focus. And Zealand Pharma is an interesting one to watch. So they got a complete response letter from the US FDA on the company's new drug application for glepaglutide. They're so hard to say. We'll watch to see if the market reacts to that one, Guy.
We will look forward to that. Let's talk about the market open. Let's figure out exactly what is going on here. It is time for the opening trade this Friday. Wow, what a week it has been. Here we go. Let's see what numbers are getting posted first thing this morning. The FTSE 100 a little bit weaker, but to Chris' point, maybe actually it delivers a better story at the get-go this morning than we see in markets like, say, the DAX, where it does seem we are going to see some more significant weakness, but it'll take the DAX a little while to get going. So the FTSE's down by 0.2%, the 600 is down by 0.3%, the IBEX is down by 0.6%. We are seeing weakness. What is interesting is we haven't seen significant weakness off the Trump posts, suggesting that maybe it's tariffs all the way if we don't see Europe buying more oil and gas out of the United States. But you've also got the chaos in Washington to factor into your thinking as well. We didn't see that one coming at the beginning of this week. We didn't see a hawkish Fed. There's so much that we didn't know at the beginning of this week that we now know. Have the markets repositioned enough for all of this information, or is it going to take time and maybe some lighter volume to get some bigger moves around what we are seeing right now? Anyway, there's the CAC. It is down by 0.7%. I'll split the difference. We'll wait and see what the DAX does in a few minutes' time. Critty, below the surface.
Below the surface, it's a sea of red, as I said. You are seeing some of the commodity names actually underperform over in the UK, which I thought was interesting. Rio Tinto, BP, Glencore. I'm not seeing Shell in that mix, though, and that might simply be because Shell does have that exposure to the nat gas business. So if you are seeing nat gas futures up, or excuse me, contracts up in the commodity market, maybe that's having a little bit of a read-through. I'm still waiting for that to shake out. But net, it's the red you see on the screen that I think is worth paying attention to, Anna. It might simply just be a function of a little bit of tech underperformance, ASML and SAP dragging down the market.
It does seem pretty indiscriminate, though, doesn't it? I mean, sure, there's some variation between the sectors, but they're all in the red. Travel and leisure is the only one that's not down by 0.5% or more in terms of the sector performance there. That's being lifted by some of the airline and hotels names, in fact. But the underlying message from this market this morning is just a red message, isn't it? It's all negative. Financial services is the worst performing sector. Construction and materials, basic resources, you mentioned, Critty, all of those down by more than 1% on today's session.
And we should just look at some of these movers as well. Your biggest underperformer is UBS, down about 1.6%. They have a report coming out from the regulatory authority, reported to come out later today, where they're going to be investigating basically the kind of fallout of the Credit Suisse story and how many capital market requirements UBS actually needs to hold on to. The reason this is important is because Switzerland, and as a function, UBS, has had stronger requirements in terms of lending capabilities and that reserve ratio relative to some of its global peers. And that every time those headlines come out, UBS stock has moved. Perhaps that is weighing, at least in anticipation of that report, if it were to come out, down about 1.7%. There's a lot going on in these markets, but net, red on the screen. Let's bring in a true expert here. Henry Allen, macro strategist over at Deutsche Bank Research, joins us around the table this morning. I want to ask you about the cleanup at UBS, but I will ask you perhaps about what do you do in the sea of red? Is this, when you see Europe underperforming like this, at what point do you say, that's cheap, let's buy?
Well, I think there's a real opportunity in Europe as we look forward to the next year, because there has been this narrative of US exceptionalism. The US is going to do really well, and that's meant growth expectations have been upgraded considerably. But unlike 2023 or 2024, growth is now expected to be pretty decent in the US next year. So it's going to be harder to get that sort of upside surprise that has meant we've seen the relentless equity rally that we have. Whereas in Europe, expectations are still pretty weak, all things considered. But, you could make a case that there is some upside there potentially. You've got the fact that measures like Bank Lending Survey are looking more positive. You may have the chance of more political stability, particularly after the German election, if a new coalition is in place and take more action on economic policy. So, I think if you were trying to draw a narrative for next year, it is plausible. You could see some upside risk in Europe relative to the baseline.
Are we entering an era in 2025, and perhaps we're already in one, where there's an element of complacency around political volatility, not just coming from Donald Trump, but the gyrations in French politics, potentially in German politics as well? I'm struggling to see how that's getting priced in day to day, as opposed to simply limiting exposure altogether.
I think totally. I think there's been a lot of complacency because 2023 we had barely any elections, and although we had a lot of elections this year, 2024, actually, with the exception of some individual instances like France, which actually came as a surprise, there hasn't been that much volatility directly as a result. So I think that's going to be more of a story in 2025, particularly as some of these new governments, like the new Trump administration, get their feet under the table and start taking action, particularly when it comes to things like the threat of tariffs or more fiscal stimulus on the table, or as we've seen this week, the prospect of another government shutdown. These things are going to become more regular as we look forward to the next 12 months.
Henry, something else we're looking ahead to is maybe a continuation of the AI boom. Maybe we start to see some cracks. How are you looking at that story in 2025? Because there's a lot at stake for US markets in particular.
Totally. And one of the big stories, of course, has been this rising concentration of the Magnificent Seven, and their fate is basically determining the fate of the broader market. So I think all rests on how the Magnificent Seven perform. If they can't live up to the hype, and there is a lot of hype clearly, then that's going to drag down US equities more broadly. So I think that's the real test. I think the question is, though, are we going to see economic growth continue? Because can we get those upside surprises? Because the last 2 years, we've had big upside surprises on growth. Even 12 months ago, there was still a lot of residual fears that the US was headed for some sort of hard landing. But that's now gone completely. So for me, it's just difficult to see where you get that upside surprise from. And if the Fed do become more hawkish, and we know those tech sector stocks are much more sensitive to rates, then I think that's potentially a real risk for that group and for the broader equity market.
They're sensitive to rates, and something that rates are sensitive to is the mood in the bond market, and the return of bond vigilantes is another of the themes that you're calling curveballs for 2025. I mean, what do you think the role of bond vigilantes will be, in particular around US debt in 2025?
Well, I think it's waking the market up and waking politicians up for that matter, because even in the last 6 months, we've obviously had the bond vigilantes focus on France, where the gap and the spread between their yields and Germany has hit its highest since the euro crisis. We've also seen, obviously, a big focus on the UK, actually, since the budget as well. So that's 2 G7 countries, which you might traditionally think of as safe, have come under attention. And
the long end of the US curve, maybe a little bit? Is that something that stocks will watch?
I think totally. I mean, actually, if you look at real yields, we're already up to the highest since May, and some of the highest we've seen in the last 5 years. So I think that's a real risk. And if we look at the next 4 years in particular, we know that Trump has said he wants to extend the Trump tax cuts that expire at the end of 2025. We know the CBO have said that debt to GDP is forecast to exceed its previous record set after World War II over the next 4 years. So we're genuinely entering uncharted territory on that front. So I do think there is a risk at the long end of the US curve.
Are puts still cheap, and should I be buying them?
That is a tough one. I'm just burned by the fact that the last 2 years have surprised so much on the upside. I guess the thing that gives me pause now is because we've had those upside surprises, valuations are increasingly stretched at 2021 levels. And also positioning is much more stretched. Our analysis suggested, at least before this week, we were in the 93rd percentile for equity positioning, which is a big difference to where we were at the end of 2022. Even though people were very pessimistic, actually, if we look back with the benefit of hindsight, we can see your positioning was very underweight. There was a lot of scope to...
Is it harder to get upside than downside in 2025 in equity markets?
Yeah, I think so, definitely, because the benchmark on growth has been risen. And also, markets are pricing in a very benign story in terms of both inflation staying subdued and that we're still going to get rate cuts. That's still priced in. And if you look at what the Fed have done this week and the market reaction to that, they still have an easing bias at the end of the day. The Fed are not that hawkish. They cut rates, and they said they want to continue cutting rates in 25 and 26. Yet the market still sells off 3% on the back of that. So just imagine if they actually became properly hawkish or said we're going to remain on hold.
Puts cheap.
as I say, I'm burned by the last 2 years, and our base case. I think things will continue to go further from here. I don't think we're fundamentally overvalued, but clearly there is a lot of froth in the market, and you can see that in sectors like Bitcoin hitting all-time highs. You can see that in credit spreads being very tight. There's a cross-asset phenomenon that's going on here, but I'm wary of calling the end just yet, particularly if we have those productivity upsides from things like AI that have really surprised the upside in the last couple of years.
If there's an inflation uptick, as everyone is bracing for, is it the same playbook as 2021?
I don't think necessarily, because to get to the same playbook as 2021 and into 2022, you would need some sort of very, very big inflation shock that is sending inflation up to the 6s, 7s, 8s, as we saw then. And barring some new geopolitical shock, it's hard to imagine if it were just simply the things we already know about, like the tariffs, like fiscal stimulus. It's hard to see how inflation gets that out of control again, barring some big shock like that. Plus, of course, in 2021, we had the pent-up demand effects from the pandemic. We had the effects of the lockdown and all the massive fiscal stimulus that was working through. So I don't think that's the playbook. I think instead the risk is that the Fed keeps rates on hold for a lot longer than people are expecting, because I think there's going to be a very high bar at the end of the day to the Fed actually reversing course, because having moved quite aggressively since September, they've said they've got an easing bias now. I think there's a credibility issue, not that there should be necessarily, but I think there would be a credibility issue to them saying they were going to reverse course again, particularly after the most aggressive inflation since the early 1980s. I think there's that sense that they don't want to seem as though they've made a mistake in cutting and they're reversing all of a sudden quickly. So I think there's quite a high bar than pursuing aggressive rate hikes again.
So we may be paused for quite a long time, Henry. I mean, I suppose government policy, though, is pretty unpredictable at this point, and they could make an argument that all those facts have changed and therefore they changed their view if we were to see the Fed pivot towards hiking. I mean, I'm not sure anybody's sitting here saying that's happening in the first half of next year, but we got the beginning of last year really wrong.
Yeah.
So, I'm just wary of that. We, as a sort of collected entity.
Yeah. And I think it's worth bearing in mind there are potentially upside curveballs, and you talk about those curveballs. I mean, one thing that I kind of heard in your earlier segment is, what if the geopolitical risk is on the upside? What if, Trump does come to some sort of grand bargain with China? We know he fashions himself as a deal maker. In his first term, he renegotiated NAFTA and the USMCA. Just before the pandemic, they did reach a phase 1 deal with China. I think Trump's going to want success. And actually, if you look through history, often it's under hawkish Republican presidents where you get those big deals. You saw under Ronald Reagan.
Doesn't pain come first, though? If you're going to do that deal, you need to inflict pain first. You need to use the stick before you kind of generate that kind of a deal coming through. Doesn't that generate the market volatility?
I think to some extent, but already he's generating pain with the tweets, even before he's president. And those people on the other side, like Canada, Justin Trudeau coming down to meet him, they're already reacting to that. And you see, Ronald Reagan did the Plants Accords. Richard Nixon, again, a hawkish Republican, did the SALT talks that led to the anti-ballistic missile treaty. So, there is a precedent for these kind of deals being reached even under quite hawkish presidents. So I think that's a possibility.
Henry, we'll see what happens next year. Feels like we've got a very cloudy crystal ball right now. Henry Allen, macro strategist, joining us from Deutsche Bank Research. Let's take a look at the core 6. This is what we are looking at this morning in terms of the main stocks that are moving around Europe. As you can see, some fairly substantial moves for some of the biggest stocks. ASML's down pretty hard. Schneider's down a reasonable amount. Nestle under significant pressure, which is interesting as well. But LVMH is soft. Novo's soft. In fact, they're all soft. Joe Easton, what have you got? Any green?
So one space there is no green is in the pharmaceutical space. Actually, a couple of big movers, a couple of big droppers in the pharma stocks today. Firstly, Zealand Pharma, the one we flagged earlier, over in obesity, dropping today over in Denmark after saying that the FDA in the US is unlikely to approve its latest obesity drug for now. So that stock getting slammed. It's down 9%. Bear in mind, it was up around 100% year to date going into this, but that drop is even beaten by Idorsia. Now, this is a rare drug maker over in Switzerland, announcing some funding issues, which I believe is related to an antibody and blood pressure drug. That's what the statement says, and that stock down 40%. Massive declines for that stock today. Then over in building materials, we've got Hornbach giving a bit of a sales warning out of Germany, potentially some weakness in the German DIY market this morning. That's what the statement is indicating. So that one dropping around 10% currently this morning. Then in terms of those sportswear stocks, we had that big move initially in Nike in the aftermarket hours, Nike, but it did come down into negative territory. We are seeing a little bit of weakness in a couple of peers. JD Sports was the one that's a big Nike retailer, actually. Very small declines in that one, but Puma coming down around 1.2%. A couple of movements on that sector today. Then in terms of rating changes, BE Semi, now this is apparently the stock that you should be buying in the chip space. It is the top pick over at Morgan Stanley, and they've got a decent price target on that one, about 10% upside to their PT, and that one gaining 1.3% today over in Amsterdam. And then finally, IAG, the owner of British Airways, another stock that's doubled this year. It's got another buy rating. This is coming over from Goodbody this morning. They've got a 400 pence price target, trading at 302. A big rebound in long-haul travel continues, and they say you should be buying IAG, and that one is rising this morning in London.
Joe, thank you. Joe Easton with the movers today. Let's just go to the downside of the Stock 600 right now. The worst performing sector is the banking sector. And Kritty, you talked a little about UBS earlier on. That's one of the areas of weakness in financial services. But within banks, the worst performer is Deutsche Bank. And we do have these headlines just crossing the Bloomberg terminal around Deutsche Bank saying they've increased their capital of their Polish unit by 300 million euros. So there's some news flow there. And there had been some reporting around this earlier on coming from the German media. So that's certainly something we are keeping an eye on this morning.
And in terms of UBS, I already said it, I will say it again. We are anticipating a report coming out of the Swiss investigation committee, simply this idea that it could affect how many capital requirements UBS has, putting a little bit of a handcuff situation on it in terms of how they can compete with some of their global peers. Reuters reporting, I believe, that report due later out today, but we are still waiting.
Banks broadly are down. Popular is down, CaixaBank's down 1.7. Some fairly big banks that are down decent numbers this morning. BNP's down 1.6%. Is there a banking story going on? The entire banking sector I'm looking at the moment, SX7P down this morning across the board, every single stock.
Another headline from Deutsche Bank just reiterating their outlook. So in case anybody thought they were not.
Just in case we had some concerns. Coming up, President-elect Donald Trump threatening the EU with tariffs unless it buys more American oil and gas. We're going to talk about that much more next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Good morning. This is that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the opening trade. 8:18 this Friday morning here in London. And the session looks like this. It's negative. DAX and CAC in particular under pressure. But broadly across Europe, we see weakness coming through. And it's pretty broad-based. Banks, financial services, the worst performers. Let's talk about the UK market, though. UK stock bulls await vindication in 2025 with an enticing discount and large shareholder payout tailwinds for the market. The FTSE 100 has managed a more than 5% gain this year. I'm seeing things. Though it's still lags the Euro Stoxx 50 and the S&P 500 by some margin. For more, let's bring in Bloomberg's Michael Masika with details on the UK's prospects. Good morning to you, Michael. So why are analysts positive then about the prospects for UK stocks this coming year? I feel like we've seen this movie before.
Yes, we've seen that before. Good morning. It's a market that is usually quite defensive. It's a market that does well when things go slightly wrong. For next year, a lot of uncertainty about tariffs, uncertainty about rate cuts. We just had that this week. Just more uncertainty is kind of good for the UK. You have a market where you have large caps, very cheap, with very high payouts, and a lot of defensive stocks in this market. So why not have a good year for UK stocks? I mean, on a relative basis, of course.
In terms of kind of how that manifests itself, is that just I buy this for the payouts, I buy this because I'm expecting M&A? Kind of walk us through, are there other factors at play here?
So we've seen it this year. The UK was one of the most active markets for M&A. So you have a lot of that in this market, and it's mostly on mid caps, but you can see it's switched to large cap as well. There's like a willingness to bid for UK stocks because they are very, very cheap, even with a very comparable in a very comparable sector activity, like oil and gas, for example. You have UK oil and gas stocks trading at like a massive discount to their US peers when the business model is exactly the same. They're making the same kind of money. They're paying more dividends. They sometimes do more buybacks as well, but they're still trading on a very low multiple. So that needs to narrow somehow.
I'm surprised by how many Fed cuts were expectedly priced in this market, and not the bond market, but in the equity market. You talked a little bit about positioning, and you've written certainly about the positioning story as well. But does the U.S. equity market really need Fed cuts priced into it to be the outperformer in 2025?
Probably not. To answer the question very shortly, the market doesn't need that many rate cuts, especially if the economy is doing well, which is what it's doing at the moment. And that's also the reason why the Fed's had some kind of a pivot. You have like some inflation pressure coming in. You don't know what's coming up with a tariff next year, how much inflationary are going to be Trump's policies. So, I mean, they're getting more cautious. The problem is you have a situation where the market comes like max out long, like asset managers are maxed out on US futures. You had CTA that were almost maxed out as well. So you have a lot of forces in the market that pushed it higher this year, and suddenly, there's a little bit of a drawback and a pushback from the Fed. So you think maybe it's time to trim a bit the exposure.
Michael, can I ask you a slightly curveball question, perhaps? But, you operate in this area of light, which is quoted public companies. On the side, we see the rise of private markets, and that's been a theme that's been building for years. We've talked about it a lot on this program. Is this having an impact? We talked about some of the mid-cap M&A stories, for example, in London. I wonder if that's a lot of take privates. I just wonder what conversations are you having about that, or does that stay very much off your radar?
From what we see, there is a lot of interest in take private, especially in the UK market. Now, having said that, we don't have like proper data to back how much this might continue or not. But we've seen it this year. There's a lot of interest from private equity into the UK market and into other markets. But if interest rates stay elevated or more elevated than we imagine, maybe financing is going to be more difficult, and you'll have less activity in that on that market.
All right, Bloomberg's Michael Masika. I'm sure we're going to be tapping you plenty into the next couple of days and into the new year. We thank you so much for joining us around the table. Let's talk about the other news this morning. President-elect Donald Trump is threatening the European Union with tariffs if member countries don't buy more American oil and gas. In a Truth Social post, Trump's saying if the EU does not make up its deficit with the United States, quote, it's tariffs all the way. Joining us now is Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. So it begins. Will, how likely is it that those tariffs come, given that Ursula von der Leyen has already kind of made the opening offer on buying natural gas? Is this a kind of just saber rattling at this point?
I think Trump's pushing at a pretty open door here. Europe is buying a lot more oil and gas than it ever has done before. If we look at oil, we're up to 2 million barrels a day, 23% more than last year. If we look at gas, clearly the European economy can only function because it's replaced most of the gas it used to buy from Russia from the United States. I think that European officials have said that they would like to replace the remaining sliver of Russian gas, which is both LNG and this pipeline gas for Ukraine, which we think is likely to stop at the end of the year. I think officials would like to replace that probably with imported gas, mostly US, and the US is building more gas export plants. So on the gas side, I think clearly it could happen anyway, and Trump is sort of doing his thing.
This feels very transactional. Hasn't the problem been that actually the Biden administration has made it harder for us to buy gas out of the Americas? Like the messaging coming out of the Biden administration has been a little bit more difficult in terms of the narrative.
Well, they had put a moratorium on building new gas plants, but that hadn't impacted any gas exports now or in the next couple of years. Clearly, on a policy, from a policy perspective, the Biden administration in the EU talked a lot more about decarbonisation and perhaps not using as much gas. That talk is all going to go out the window. And honestly, when you look at what's going on in the German economy and the angst about energy prices in Europe, I think they're going to be pretty willing to buy what is, in a global context, good value energy from the US. So I think, Trump's putting himself in a place where he can almost make his point and declare victory.
There you are. Well, yes, sometimes we need some quick wins, don't we? What about the price of oil right now, Will, as we head towards the end of the year? 72.47 on Brent. I mean, drill, baby, drill has been a mantra. He seems to be happy to sell a lot more energy products to Europe. I wonder how low he's prepared to push prices.
I think he wants low prices. Clearly, in US politics, the price of gas, what people pay at the pump, is an enormously prominent, and it's really seen by a lot of American consumers as a proxy for inflation, so he won't want to see that rise. There is a little bit of gloom about the oil market next year, partly because US production will continue to rise, although how much Trump can actually make a difference, I think, is a moot point. Okay. But there are lots of things we don't know yet. We don't know what's going to happen to Iran, and we don't know what's going to happen to the Chinese economy.
Thank you so much, Will. Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. When we come back, we'll talk European politics some more. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I'd like to suggest to the upcoming presidencies to be brave. Well, this was our slogan for our presidency: "Make Europe great again." This is our only chance. Thank you.
The Hungarian Prime Minister, of course, Viktor Orban, speaking at the EU Leaders Summit yesterday. Let's get more from that summit and what we've learned from it. Bloomberg understands that Viktor Orban has told European leaders that he wants to wait until the inauguration of Donald Trump before deciding whether to extend the bloc's sanctions against Russia. Let's talk more about this. We're joined by Bloomberg's Ollie Krug. Ollie, how have those comments gone down with other leaders?
Yeah, so listen, Guy, I mean, Orban is kind of the disruptor-in-chief here on the EU on a number of different issues, but perhaps none more important than the issue of Ukraine, particularly when we're getting out of European leaders. Some of the same comments we've heard repeatedly from them since the beginning of the war, reiterated by von der Leyen last night. The main message today was full support for Ukraine as long as it takes. What that means is trying to bring in more sort of military gear to the battlefield, but realistically, that's really sort of maxed out here in Europe to a certain degree. There's not going to be any major breakthrough here. The real concern is actually subtracting some of the supportive measures, and that is namely on sanctions. We have had 15 rounds of sanctions from the European Union because these need to be re-upped every 6 months. They need to be re-ratified by the EU 27 members of whom, of course, Hungary is one of them, and can block it. What we understand is that Orban now is not willing to sort of roll over these sanctions until the inauguration of President Donald Trump. That is on January 20th. The next deadline for those sanctions to be rolled over is January 31st. And this is just sort of part of the whole constellation here in Brussels over the last 24 hours or 48 hours, where basically Trump is looming large over everything. And there's this very clear sense that Europe is really just in reaction mode, waiting for this presidency to come underway. And the question is, how much of an impact will Orban have? We are getting some other ideas. We should say, Valdis Dombrovskis, for example, the European Commissioner for the Economy, says that we shouldn't abandon the idea here in Europe of looking at not just taking the proceeds from the frozen Russian assets, but actually tapping the underlying Russian frozen assets, getting those to Ukraine. That is obviously much more complicated, much more controversial. When I spoke to the Luxembourg Prime Minister going into the meetings, he's part of all these discussions with all the leaders in Europe. He says that that's really not on the table, but this is something that some leaders want to continue exploring.
Okay, and we were just looking at images of Volodymyr Zelensky arriving at the summit just this week, Ollie, and there's been some news flow surrounding Ukraine and Putin and the deal around gas for Europe. Fill in the gaps for us.
Yeah, so listen, this is something that has been a very sort of a strange feature of this war since the very beginning, where you still have Russian gas that's flowing through Ukraine. Ukraine's getting paid for that, and then being delivered to Europe, which is paying that money to Russia, which is then using that money to wage its war on Ukraine, which, of course, the Europeans are trying to prevent and fighting against. This has been just a sort of very strange dynamic since the very beginning, and there are these sort of transit agreements that basically guarantee that this gas can go through Ukraine. Those were set to lapse at the end of this year. There was a lot of questions about how to maybe work around it, because this would hit a number of Eastern European economies within Europe, namely Slovakia. But basically, it will not be renewed. This is what we heard from Zelensky. This was something that we were sort of debating when we spoke to Zelensky earlier this year. The question is now, because this is only about 8% now of European gas. So it's not inconsequential. It's about 15 billion cubic meters of gas every year. That's down from the 150 that came from Russian pipelines before the war. But again, it still has something of a material impact. We saw natural gas prices go up about 6% yesterday, and the natural gas storage facilities right now are much lower than they are in traditional years here in Europe. But basically, overall, Europe is much better positioned to deal with this, but it's still significant within the market.
All right, Oliver Crook, we thank you so much for breaking the story down, joining us out of Brussels this morning. Let's take our news and look over at France as well, where Bank of France Governor Francois Villeroy de Gallo has urged the government to target a significant deficit reduction. New Prime Minister François Bayrou says he hopes to name a new government by Christmas. Joining us now to discuss the latest is Ludovic Subrin, chief economist over at Allianz and a member of the French Council of Economic Advisors. A pleasure to have you on the program as always. Let's just start with how likely it is that we do actually get a budget. What does that timeline look like? Are we looking at months, weeks, days?
Well, it counts in months, in weeks and days. The idea is mid-February. So you see, you can count in all three units. Look, François Bayrou seems to be confident he could name a government before the end of this week. That means by COB tonight or before Christmas, he said. But more importantly, there are good grounds for a budget by mid-February that would be friendly, I would say, of the demands of the far-right party, which is really the topic. So that would be maybe a less ambitious budget, so less than a point of adjustment, fiscal adjustment. But that would, for example, not touch on healthcare and pensions, which is a big middle-class topic that the National Rally has been focusing on. And that would also be maybe less ecologically punitive, which is also one of those topics that the far-right parties are pushing forward these days. So Bayrou seems to be confident he can get that by February. The good news is that we have a special law for budget. So it's a bit business as usual with, some adjustments actually in the making from that special law, especially the fact that income taxes will not be indexed for inflation. And so most French people will have to pay a bit more taxes on 2024.
So the austerity baked into that loi spéciale actually helping in a little bit for in the meantime. Walk us through, though, the effect, understood, very little, the effect of the markets here, because there's a conversation that as you start to see the spread between French and German debt widens, even if it is slowly, there are financing constraints placed on French corporates, on French citizens as well. Can you connect those dots for us, the market moves versus the actual economic impact?
Look, I mean, first, the good news is I think markets are reacting quite positively. There is a spread that is there that is basically rooted in the additional political uncertainty and fiscal uncertainty on France, and that has been on since June. There was a bit of widening when, the government resigned, or actually the no confidence vote was passed. But then since then, it's actually very much under control. So we're talking about 80 bips of spreads with Germany, give or take, which is okay. Of course, the problem now, it starts to pass through to the corporates. And as you can imagine, it will also pass through on mortgage rates, because even though the ECB continues to loosen monetary cycle, you can imagine that the fact that the French, issuances have a bit of a risk premium, even if it's 20 basis points, is something that will certainly play into the bank's likeliness to lower even faster the mortgage rates. So there is these financial conditions that are a bit on the tighter side. It's quite slow and it's quite circumscribed. The big issue, as you know, with this spreads topic is, of course, the nonlinear nature of them. So right now, there is no fear priced in. There is just this uncertainty priced in. But of course, everybody has been talking about the president resigning. A lot of people have been talking about the situation being worse than it is. So there is this risk that it could actually jump to 100 basis points. I think it's a low likelihood scenario, but this would have a bit more effect, of course, on the corporate financing, on private equity, on leverage buyouts. All of these financing conditions that France has actually been benefiting from the loosening cycle from the ECB could be halted a bit should this situation continue. But it's okay for now.
Ludovic, the incoming US President, Donald Trump, has posted this morning talking about the idea that the Europeans need to buy much more oil and gas from the United States or it's tariffs all the way. Is Europe focused enough to deal with Trump right now?
Look, I do think we are. It's true that the problem is, the fact that Germany is going for elections, the fact that there are a minority government in a series of countries. We are looking a bit too much at our belly button, to be honest and to be blunt. But as you know, markets are extremely driven by the Trump playbook, including the 333 of Secretary Bessent. So, of course, the drilling and the oil is an issue. I do think it will get better by the first half of the year, especially when we get a new chancellor in Germany, because then everybody was going to be about, okay, do we go for a tit for tat, like Italian law type of situation with Trump? Or, as Christine Lagarde pointed out in an article, do we negotiate? And especially on defense and on oil and energy. I think the Europeans are much better off negotiating. And I think this is the real learning from Trump 1 was, the more you negotiate, the less likely it is that you get extremely, negative sanction batches, right?
But you have to spend and you have to deliver, and you have to deliver on defense. Is Europe capable of making those big decisions? Is Germany, France capable of making those big decisions at a point when we have such economic uncertainty and political uncertainty? You need to have a pretty clear idea of where you're going in order to make some of those big decisions. If we're going to boost defense budgets to 3%, if we're going to buy much more oil and gas, all of these are, the oil and gas maybe is an easier one, but these are big decisions that Europe has got to make. And I'm just wondering if Europe can move quickly enough to satisfy Trump's agenda.
Look, I mean, there is, on paper, I think President-elect Trump has an issue with who is his counterpart. Because, is it Ursula von der Leyen? Is it Antonio Costa? Is it Emmanuel Macron? Is it the new Chancellor of Germany? This is the problem. But in reality, all of these people are very much aligned. I think the candidates, the two main candidates for Chancellor of Germany have shown that they're very committed to increasing defense budget. I think there is no doubt that Macron, Meloni, Sanchez also want to do that. So I don't think we have an issue here. The big problem is more the substitution effect. So if the fiscal is tied to 2% or even 3%, which is the latest NATO member type of discussion, defense spending, how do we finance the rest? Social protection, infrastructure. And this is when the other building blocks come together, especially, maybe we will get Eurobonds for defense, but that means, we will get more subsidiarity on other topics like climate. Or maybe we need to be a bit smarter on this so-called savings and investment union. That means the capital markets union, because we will need to get additional financing from the banks and from the markets on some of these other topics, especially infrastructure, transport, green, and so forth. So I think the commitment we can get there at the speed of Donald Trump. I think the implementation will take us longer because some of these blocks, institutional and financing flows, are not there yet. Yeah.
Ludovic, I'm going to give you a challenge now. We've spent today thinking about 2024 and pushing ahead to 2025. And I wonder what we'll be talking about this time next year. I mean, do you have a sense of the way that next year is going to unfold? Or is there just too much fog, to use the metaphor that one of the metaphors that Jerome Powell was using this week?
Look, I think it's going to be a three sequence year. First third of the year, it's going to be US, US, US. Second, it's going to be Europe, Europe, Europe. And third, so when we're going to be talking again next year at the same time, it's going to be China. Because by then, we're going to see a bit whether the Chinese stimulus worked. And we're going to be a bit clearer on how much of a trade war we're talking about. So it's going to be very determined in this way. So let's get tuned for, all eyes on America for the first third, then all eyes on what Europe can actually do. And then it's going to be China. And thank you for showing our weekend outlook. We're very proud of this one. I've always been a musical fan, and the team actually bought into my craziness one more time. So it is worth a read, I hope. I prefer the musical over the movie, but, I hope you guys got all the puns and jokes intended. Yeah.
That's okay. Ludovic going with the original. Thank you very much. Ludovic Subran, Chief Economist at Allianz. Thank you so much for joining us, and we wish you a pleasant end of year, New Year, and 2025. Now, the US Secretary of State, Anthony Blinken, expressed cautious optimism about the prospects for a ceasefire deal in Gaza. Speaking to Bloomberg's David Gura in New York, he says the chances of a deal have now improved.
The reality is we should logically be able to get this, and I say that with all the caution that comes with that statement, because, you know, we've been very close before, and we've had these Lucy in the football moments where you're just ready to kick the football and Lucy pulls it away. But what's changed is this. Hamas knows that the cavalry's not coming to the rescue. For months and months and months, it hoped it would get a wider war with Hezbollah, with Iran, with Iranian-aligned groups coming in and creating more problems from Israel on more fronts and helping Hamas endure. We now know that's not happening. They know it's not happening because of the very important work that was done with us and with others, dealing with the unprecedented Iranian attacks on Israel, dealing with Hezbollah. So I think that's concentrated minds among Hamas on the need to complete this deal. Having said that, you know, it's always incredibly fraught, and it's very hard to get decisions made. It's hard to communicate, and for all of those reasons, even as close as it is, you know, it can still move in the other direction. But we've all been fanning out, working with all of the different partners who can make a difference and who may have some leverage with, communications with Hamas, whether it's Qatar, whether it's Egypt, whether it's Turkey, where I was just last week. The fundamental question right now is Hamas finally prepared to say yes? And if it does, we get the hostages back. We get a ceasefire. We get an immediate, dramatic improvement in the lives of Palestinian children, women, and men who've been caught in this horrible crossfire since October 7th of Hamas's making. If they really purport to care about the Palestinian people, they will say yes and do it now.
US Secretary of State Anthony Blinken, there was his thoughts on Middle East developments. Away from that area of geopolitics, Guy, we do have some weakness to talk about in US futures this
worth paying attention to. So coming into this morning, the number that you needed to know was 5906. That was the low post-Powell in E-mini futures. We've now cleared that to the downside, which could open up significantly more weakness as we come through into the session a little bit later on. We're now trading below 59, 58.94. Coming into the session in the United States a little bit later on, but we're already starting to price that in, obviously, in terms of our thinking this morning. So we've cleared 59.06, 58.94 is where we are now trading on E-minis. Coming up, a government shutdown looming in the United States, a factor in what I've just been talking about. More on what we should expect after the Republican-led House rejected the funding plan backed by incoming President Donald Trump. That's next. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Very disappointing to us that all but 2 Democrats voted against aid to farmers and ranchers, against disaster relief, against all these bipartisan measures that had already been negotiated and decided upon. Again, the only difference on this legislation was that we would push the debt ceiling to January of 2027.
U.S. House Speaker Mike Johnson speaking after the Republican-led House voted down a temporary funding plan backed by President-elect Donald Trump. Now, the rejection sets the stage for a potential U.S. government shutdown, with funding set to lapse tonight, midnight time on the East Coast. Let's get the latest now with Bloomberg's Joshua Gallu. Joshua, pleasure to have you on the program this morning. Walk us through what happens if there is no deal. What are the next steps, first on the shutdown and then on the debt ceiling?
On the shutdown, that would happen at midnight tonight if there's no deal. That's the deadline. The continuing resolution that they're talking about is really meant to keep the government running only for another 3 months, and then it would have to be done again, or a proper budget would have to be discussed. If they hit the deadline tonight, then essentially the government shuts down tomorrow, which really doesn't, on a Saturday, it doesn't have as much effect as it will on Monday. But you start to lose services, national parks will be closed, and you will probably have a lot of disruption in travel if TSA employees, for instance, don't entirely come to work when payment starts getting delayed. It usually doesn't have a major impact initially, but in this case it could. And with holiday travel happening right now, I think people are not going to be very happy about it. In terms of the debt ceiling, that is something that has a much graver effect.
Then, Joshua.
Sure. The debt ceiling was essentially, this is something that allows the government to borrow to fund its expenses. And back in 2023, they made an agreement to table that issue for 18 months so it didn't interfere with the elections this year. It expires on January 1st. That means that the government will not be able to issue new debt, but instead, Treasury, through emergency operations, will be able to fund the payments that it needs to make. That can't last forever, and the experts say that would run out around summertime. So the debate over the debt ceiling has always been expected for the first half of this first year of Donald Trump's presidency. But what happened and why this fell through is that it was not part of this continuing resolution debate. Trump wants to fit it into Biden's presidency at the last hour, so he doesn't have to bear that burden. But he wants to extend it for 2 years or get rid of it altogether. That's a very unpopular opinion in his party. So what you've seen is that the more conservative Republicans have said no way, and they've fought against this provision that Democrats have actually looked for in the past. So the likelihood that the most conservative people in the Republican Party would then get on board for and vote for extending the debt ceiling doesn't look very likely.
Joshua, thank you. Thanks for bringing us the latest. Bloomberg's Joshua Gallu with the latest developments stateside. In perhaps a sign of things to come, President-elect Donald Trump has been busy in early European hours, threatening the EU with tariffs all the way. So more tariffs. We're joined now by Bloomberg's Valerie Teitel with some guidance on this subject. We've been watching for evidence of this in stocks. I mean, stocks are weak in Europe, but they're also weak in the States, Valerie. So I'm not sure what that tells us. I guess let's look at this from an FX lens. implications for the dollar?
Yeah, I think this tariff threat, both of these options that the negotiation can go are both positive for the dollar, which does complicate Trump's success in some way. Either if he goes ahead and puts tariffs on the EU, or if he is successful in closing this trade deficit, if he is successful with getting the EU to buy more oil and gas, that is another dollar positive. Buying more U.S. goods, increasing that trade in terms of U.S. exports is going to increase demand for the dollar. And I think this is where the pickle really lies here, Anna, is because for Trump, he really does need to have a weak dollar going forward if he does want to revive U.S. manufacturing. He also seems to think that these trade deficits, he's calling them as the U.S. subsidizing other countries. He claimed that when he was speaking about Canada a few days ago, saying the trade deficit with Canada is the U.S. subsidizing Canada. So he really does want to get rid of these trade deficits. But again, that is a strong dollar policy. It is going to complicate how he reshores U.S. manufacturing.
Plaza Accord? Is that the kind of the logical? Is that ultimately where this goes? Some sort of deal like that weakens the dollar, others spend more. That's the change that we need to see.
I think that could be a real theme for Q1 of next year, a Mar-a-Lago Accord, should we call it? Because for Trump to claim success for these policies he wants to push through, he does need a weak dollar in the background. And let's not forget, a hawkish Fed, like we got a few days ago, only makes that worse. Yeah. We saw the dollar jump.
So we're setting up a fight there as well?
Perhaps. We do have a Fed on hold for much of next year alongside other central banks cutting, like the ECB, like the Bank of England. That only poses more dollar strength and perhaps presses the need for some weak dollar policy to come out of the U.S. administration.
All right, Bloomberg's Valerie Teitel walking us through maybe what's going on in Donald Trump's mind. We thank you so much. Later today, we're going to get another view. We're going to speak with San Francisco Fed President Mary Daly on the Fed's decision and the outlook for next year. That coming up at 12:30 p.m. UK time.
You guys are done, aren't you? That's it.
Yeah, we are.
Christmas is coming. I'm gonna be here next week, but you're not.
Well done. Thank you.
Okay.
That
takes
Taking one for the team.
Takes us into the weekend. You guys, I'm sure, are going to be doing your Christmas shopping, getting ready for the holidays. There are other things happening. It's got the Tottenham Hotspur Liverpool game, the Spurs Liverpool game. I'm actually more interested in the Villa City game. I think that's going to be absolutely fascinating.
I like how he thinks we haven't done the shopping already, and we're not.
Have you done the shopping?
Yes. It's
okay. Have you done the shopping?
It's the 20th.
I think there's evidence this morning that I've done my shopping. Yes,
okay,
absolutely.
That is fair enough.
Are you going to be seeing The Lion King? Are you going to be having carols at the Albert Hall? Are you going to be watching? Are you going to be at home to the Furies?
I'm not going to be watching any of those things. I can tell you, there's no darts on the list, so I'm moving swiftly through the weekend teaser. Let's go to the Blackstone video, shall we? Because this is a festive tradition now. The 2024 one dropped, and it seems, Guy, you make a cameo. I mean, it's brief.
Quite far in. It's very brief.
It's brief, but it made me think, what do we need to say this year about the video to make it into the video next year?
Well, there was
getting quite meta.
Maybe some hidden talents.
There was a good chunk of Taylor Swift talk as well.
In the background.
Made a quick debrief, but there was a Taylor Swift theme to it, and I think maybe your fangirling has finally paid off.
It is. That's how we made it. I remember it being a big deal last year. It's very entertaining. You'll find it online. It is definitely worth watching.
Well, private markets as reality TV, that's genius. Make that programme. There you go. That's
I like the Larry Fink cameo is the best bit.
That was excellent. That was genius. That is it for the opening trade. The Pulse is up next. Have a good day and week, everybody. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
President-elect Donald Trump threatens the EU with tariffs unless its members buy more American oil and gas. Meanwhile, in Washington, a U.S. government shutdown looms after the Republican-led House rejects a temporary funding plan backed by Donald Trump. And investors wait for the Fed's preferred inflation gauge, the last major piece of data for the year after the central bank's hawkish pivot. So there is quite a lot going on. It's been a busy week. And actually, we thought we were winding down ahead of the holiday season. Not so when you look at some of the Trump social media policy making. Now, this is a picture across the board, a bit of pressure with, for example, the FTSE down some 0.7%, the CAC 40 and the DAX also down 1%. The Trump tariffs are basically hurting a lot of psychological as people start to unwind before the holidays. Again, he's threatened the European Union with tariffs, of course, if the members don't buy more oil. In terms of what this means for a lot of the stocks, so S&P futures down 0.5%. We're seeing similar pressure also as some of the trading, of course, is unwound ahead of the holiday season. The U.S. 10-year yield 4.5583. A lot to talk about when it comes to Fed. Bitcoin 95,383, and finally Brent crude 72.35. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. President-elect Donald Trump has threatened the European Union with tariffs if its member countries do not buy more American oil and gas. Now, the EU is already a major buyer of U.S. liquefied natural gas and has discussed purchasing
States since 2021. About half of the natural gas in Europe now comes from the United States. So all of that is basically moving in the right direction. And you can add to that, too, some news that we got over the last 24 hours that Ukraine will basically discontinue its gas transit deal with Russia, meaning that about another 8% of all the European gas that comes still from Russia, that is no longer there. That's 15 billion cubic tons of gas that will have to be filled in. That could potentially be filled in by the United States. Again, good news and potentially some goodwill that they could get with the president-elect of the United States.
Ollie, thanks so much. Oliver Crook there in Brussels. Now, the Republican-led House has voted down a temporary funding plan backed by President-elect Donald Trump. The rejection, of course, sets the stage for a potential U.S. government shutdown with funding set to lapse Friday night. Now, let's get more with Bloomberg's Joshua Galou. So, Joshua, I mean, this failed for a number of reasons, but how dangerous is this?
Well, look, it's certainly not the first time that the government would shut down. There have been more than 20 instances from since the 70s. It's a very dysfunctional budget process. But the key here is, you know, in 2 weeks' time, it's less about the actual impact of the shutdown than it is about the signs that we're seeing about a good process going forward, and also a sign about President Trump's power within his party. So he's asked for this debt limit to be raised, as you know, for 2 years. This is something that actually Democrats have fought for in the past, and it's made clear a big rift in the Republican Party, because you have the conservatives who never support such a thing and won't vote for it. That means they're going to have to work with the Democrats because they won't have enough votes to pass anything. At the same time, this could jeopardize Trump's biggest agenda items. He wants to make permanent his tax cuts that were there in 2017. They're set to expire this coming year. That's a major piece of legislation, plus border security spending. There's trillions of dollars the U.S. is going to need to be able to increase the debt limit to service his agenda. He's going to have to build a coalition. It's going to be interesting to see how that plays out.
So, Josh, I guess, how does it play out? I don't know exactly what happens next, if we will have a deal early next year, if it could come sooner. But is this also a template of things to come under the Trump administration?
It seems like a template of things to come. I mean, the way this plays out in terms of calendaring, the government is poised to shut down tonight at midnight if a deal isn't reached. And then it'll stay shut down until they actually reach a deal. That, when they do, that only provides for the government to continue spending at current rates for 3 months. So it'll have to be readdressed, either another continuing resolution in 3 months in March, or they get back into an omnibus budget discussion, which also has to happen. So there's that piece, but there's also overlying that is on January 1st, the debt limit agreement expires. So it would either have to be suspended again before then in this deal, or at that point when it expires, the U.S. will have to finance itself on emergency funds through the Treasury. That is expected to run out in summertime. So a big debate about the budget is going to last for several months here.
Joshua, thank you so much. Joshua Galou there with the very latest, of course, on what's happening in the U.S. Now, markets turning their attention to the U.S. PCE inflation data out later today. It's the last major piece of data for the year and follows the Fed's latest hawkish policy pivot. We're now joined by Laureline Chatelain, a fixed income strategist at Pictet. Laureline, thank you so much for joining us. It's been a big week, certainly when it comes to treasuries. How do you see the government shutdown also playing out in some of the concerns when it comes to U.S. debt?
Thank you very much for having me. So I think if we look at U.S. debt, I wouldn't say it's a short-term concern. The movement we've seen on Treasury yields this week have been really linked to the Fed and to this change in terms of projection, this hawkish tone that says that basically they are ready for a pause and that they have revised quite sharply up the expectation for core PCE, encompassing potentially the effect of future Trump policy. So I would say for now, the Treasury market is more focused on the Fed and what it will do next than short-term on this budget funding in the U.S.
Laureline, there's a lot of concern, actually, when it came to that hawkish messaging from the Fed. Are they just getting positioned because they don't really know what the Trump administration brings in terms of policies, or is it really difficult to get inflation down in the last mile?
So it seems when we read the minutes and also from the press conference that some members at the Fed did actually put revise upward the expectation in terms of inflation linked to potentially the effect of tariff or a reduced immigration that could also boost the labor market and wage growth. So it's not clear if it's really the core PCE data that we have had over the past months that was a bit stronger at 0.3 months on month, or if it's really much what the participants expect for next year with Trump.
So, Laureline, what's your take on how do you build your portfolio around fixed income?
So looking at the yields movement we have seen this week, honestly, we believe that the 2 to 5 year part of the U.S. Treasury curve is now very much more attractive. We're getting yields that are close to the mid-Fed fund rate. And when we look back at history, that was the case only in 2022 when the Fed was hiking. So unless we go in for a scenario where the Fed is hiking next year, which we don't have, we see some further cuts, we believe the good carry we get now on the short to mid part of the Treasury curve is very attractive.
What would it take, actually, for the Fed to have to hike rates? I don't know if inflation has to really shoot back up, or whether there's a base where, because of immigration, taking some of the workforce out in the U.S., or trade and trade wars and extra tariffs really could make that a 20% probability.
So I guess you need to look at what they project, for example, for core PCE. So they have 2.5 for 2025. That has been revised up from 2.2. They have 2.2 for 2026. That means that they are already putting in their scenario the fact that they are not going to get back to the 2% target that they have over the next 2 years. So in this sense, I would say the risk is more on a downside surprise on core PCE than an upside surprise. But obviously, to your point, if it really surprises higher than that, we could well consider maybe hikes, maybe 2026 more than next year.
Laureline, thanks so much for joining us. Laureline Chatelain there from Pictet stays with us. Now, a couple of corporates we're also watching out for. FedEx shares higher pre-market after the company said it plans to spin off its freight division into a separate publicly traded company in a deal that will streamline the parcel giant. 8% higher for FedEx pre-market. Also, Nike, the world's largest sportswear company, reported revenue, profit, and gross margin that surpassed analyst estimates in the last quarter. But the sales slump that began under the previous CEO, John Donahoe, has persisted. Nike down 4%. Coming up, the pound declined after the Bank of England held interest rates, but with a pretty dovish vote split. We'll discuss the outlook for the UK next, and this is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Course of interest rates, the path is downwards, but there is more uncertainty around, and so we had to weigh that up very carefully. And I think the appropriate thing to do at this meeting was to keep interest rates on hold, but we'll come back at the beginning of February for our next meeting and start it all over again and review the evidence. But I think the fact that there is a difference of view within the committee, I think first of all, I think it underlines the strength of our process. There's no groupthink on the MPC. Reasonable people can take a different view at this point, and that's exactly what they've done.
Well, that was the Bank of England Governor Andrew Bailey speaking after the central bank held rates yesterday. Let's also dive deeper into the latest market moves. We're joined by Sonali Punani, UK economist at Bank of America. Sonali, thank you so much for joining us. I mean, it was quite a week. We're joking around. Yes. We said that it's been quite a week in terms of market pricing for the BOE, but also just trying to understand how they'll react to the Fed. I mean, I guess the biggest question for next year is the UK actually going to be headed for a recession?
I mean, we don't think so. We still have growth picking up into next year, mainly because of the fact that we're getting a lot of fiscal easing. I think the composition of the economy is going to change a little bit. So obviously, you're going to see some weakness in the private sector as they absorb some of these employment costs that are coming as a result of the budget. But we do think that the public sector is going to take a large part of the growth engine into 2025. And we see some growth pick up on the back of higher public spending, higher public investment, kind of compensating for maybe some of the weakness that we see in the private sector and in consumption. So, I mean, the outlook is that growth should pick up. Also, consumers are likely to continue to see, their real incomes continue to grow. The impact of rate hikes are behind us. We are going to see some easing potentially, maybe slower than other central banks, but still see some easing. So that should support the economy. But obviously, risks are to the downside. We've seen what the data has been doing in the last few weeks, so we have to be cautious going into next year.
And so, I mean, a lot of uncertainties, right, about some of the, I guess, assumptions that we're making now.
Yes.
Is the fact that, we don't really know how companies will respond, as you rightly say, to this rise in payrolls tax. Is that the biggest one? And when do we know? Is it, beginning of 2025, kind of second quarter, early second quarter, or do we need to wait until the middle of the year?
I think we are already getting some evidence. The bank has been doing surveys in the ground, trying to ask companies what they're going to do, and companies are giving a mix of responses that they could either raise prices, that they could either lower some of the wages or reduce employment. So we are getting some evidence. Obviously, it's not clear yet. There's a lot of uncertainty. I would assume that, as we head more into the first half of next year, we get more evidence. April is when these payroll costs really hit, the company's accounts. So I think by then we should have a good idea about how the companies are planning to respond to these employment costs.
I mean, the easiest question is basically what impact will Trump have? I mean, it's impossible to game, right, at this point.
It is very hard. I mean, the thing is, one thing to note is that the UK is a services-driven economy. A large part of the exports to the US are in services. And so while there would be sectors in the economy that might be potentially impacted negatively by the Trump tariffs, the impact on the overall economy might be muted by the fact that we're exporting a large part of our exports to the U.S. are in services. So relative to what maybe the impact might be on Eurozone, the UK is probably a bit better sheltered. But UK is still an open economy. If there is global slowdown in China and slowdown in Europe, that's going to affect us. And we did see the governor allude to that. Obviously, they said that the impact would be known only in some time, but things like trade policy uncertainty indicators are picking up, which is something that could also be weighing on sentiment at this point.
So now, let's also bring in Lorraine Chatelain, fixed income strategist at Pictet. Lorraine, when you look at, you're in your space, basically in your world of fixed income, what do you do with gilts at the moment, given all of the uncertainties?
So the gilt is an area of the market that we actually like. So we are neutral overall on gilts, but it's true that we see some signs of inflation potentially coming down next year. We do expect the Bank of England to cut rate more aggressively than market participants currently expect. So we have 3.5 as a terminal rate for the BOE. So that could bring yields lower in the UK.
Lorraine, we were talking with Sonali about some of the things that, we're watching out for. How difficult is it to know the Trump effects? And again, this could, I guess, start a major repricing amongst fixed income away from the U.S. I mean, there's a belief that the U.S. will kind of manage, but the rest of the world could really be hit.
Yeah, so it's all about this policy rate divergence that we could see, actually, because when you think about it, tariffs are indeed inflationary for the U.S. if the U.S. impose them on other countries, but that's actually potentially reducing economic growth in the countries that are hit by this tariff. And in that sense, I really think about China, for example, or Europe, and there we could see more monetary easing from central bank, whether it is the PBOC in China or the European Central Bank in Europe. So that could bring a strong yield divergence with higher yields in the U.S. and lower yields in China and in Europe.
Sonali, where do you think rates will be at the end of the year? Next year.
We are forecasting 100 basis points of cuts into next year. So we think that the bank would, cut rates gradually. We are aware of inflation persistence risks that the UK is facing. So as a result, it's going to be a gradual cutting cycle. We don't really share some of the very deep concerns that some of the dovish members have about growth slowing down very significantly and the labor market cracking very significantly. So we think that it's going to be a gradual cutting process. But, as was alluded, I think the markets have gone a bit too far in terms of pricing out cuts in the UK. There's barely 2 to 3 cuts priced. So maybe that's going to be a bit of reprisal on that kind of cutting path as we get more and more data going into next year.
What do you think is a plausible range for the neutral rate? Because I stopped asking what the neutral rate is, but is it between 3 and 4%?
Yeah, I would think that between 2.5 to 4. I know it's a very wide range. I mean, I do think that there are evidence that neutral rate potentially is higher now in the UK relative to a few years ago. I think the inflation persistence story would mean that we need higher policy rates at this point to keep inflation at the 2% target. And then we obviously have an additional fiscal easing, which is also inflationary. So I think all of these measures means that we're not going to go back to where we were prior to the pandemic and be at potentially higher terminal rate relative to what we were in the past.
And Laureline, I mean, January, February is going to be a big months also for France and therefore French bonds and also Germany. How do you play Europe right now?
So it's the part that we prefer in the market. So we overweight European sovereign bonds. You're right to point that there's still a lot of political uncertainty in Europe, in Germany, in France with this new government that we expect, and in Germany with the election. But when you look at the broader picture in Europe, we have had good sign in terms of inflation this week. We know that growth is rather on the downside in France and in Germany. And so the European Central Bank potentially have room to cut below neutral, which means that they become very stimulative.
Thank you both for joining us today. Laureline Chatelain, their fixed income strategist at Peak 10, Sonali Poonami, UK economist at Bank of America. I hope you're winding down. I feel like, the market, there's never a good time to wind down for the markets because there's so much going on.
Hopefully we get a quiet couple of weeks.
Hopefully. Now, we'll have plenty more, of course, on the markets, on the Fed, and on Donald Trump next. This is Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back, everyone. Now, federal prosecutors in the U.S. have charged Luigi Mangione with the murder of United Health Group executive Brian Thompson. Now, the 26-year-old's lawyer said the charge is a sign that prosecutors may seek the death penalty. Mangione allegedly shot Thompson from behind on a street in Manhattan earlier this month. Now, Starbucks Barista Union says it plans to go on strike for 5 days from Friday across stores in Los Angeles, Chicago, and Seattle. The group says the decision comes after the coffee chain presented a package that offered no immediate raises for baristas. Now, the union expects the strikes to spread to hundreds of stores by Christmas Eve. And Bloomberg has learned that VW and labor leaders are moving closer to a restructuring deal without shuttering factories in Germany. Now, sources say management is willing to keep plants running and reinstate job security agreements until 2030. That's in return for workers foregoing bonus payments. An agreement would prevent widespread walkouts and hand the chief executive, Oliver Blume, the fresh start he's seeking to turn around Europe's biggest carmaker. Coming up, President-elect Donald Trump threatens the EU with tariffs unless it buys more American oil and gas. Well, we'll discuss U.S.-EU trade with Ilham Kadri, the CEO of Syensqo. That exclusive conversation is next, and this is Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower, and as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg. Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. President-elect Donald Trump threatens the EU with tariffs unless its members buy more American oil and gas. Meanwhile, in Washington, a U.S. government shutdown looms after the Republican-led House rejects a temporary funding plan backed by Donald Trump. And investors wait for the Fed's preferred inflation gauge, the last major piece of data for the year after the central bank's hawkish pivots. Now, U.S. President-elect Donald Trump has threatened the European Union with tariffs of its member countries do not buy more American oil and gas. Now, for more on the EU's trade pressures, I'm joined exclusively by Dr. Ilham Kadri, the CEO of Belgian chemicals company Syensqo. With a market cap of around 7 billion euros, it was formed by spin-off from chemical manufacturer Solvay last year and makes specialty chemicals used in the production of everything from airplanes, electric vehicles to mining and oil production. So, Dr. Ilham, thank you so much. This is like an annual occurrence.
Yeah.
So you've had a very busy year. There's been a lot going on. What do you think has been your success rate so far? I know you've done a lot. You've also pivoted to green.
Well, thank you for having me, Francine. Yeah, I was here a year ago, just when we spun off our company. So I'm very excited. We just celebrated our first year anniversary, up and running. It was a startup, 7 billion market cap, as you said. 13,000 people around the world. So here we are with a solid balance sheet. We delivered the cash we committed to, and we show to the world that we can launch IPO separate, specialty company devoted to grow, to innovate at the service of lightweight, electrification, connectivity, and biotechnology.
Where does actually chemical and chemical makers sit? We're speaking also this week to the people that bought Covestro in Germany.
Yeah.
I mean, this really seems to be like a new frontier of how to do growth. Yeah. But with that comes a lot of trade concerns and possible tariffs.
2024 has been a very soft year for the chemical industry in general, and most of the stocks are undervalued if you look at them. But the reality is that there is no strong economy without a strong industry. And there is no strong industry without strong chemical industry, because we are the mother of all industries. We are invisible, but we are in your car, in your chips, in your bio shampoo. So you need chemistry specifically to actually manage the energy transition, right? To manage the green, and electrification and connectivity. The world needs more and more. So yeah, it has been tough, but at the end of the day, companies like ours, like Syensqo, is actually ready to engage with growth opportunities, right? Which are offered by all those megatrends.
The concern amongst a lot of European CEOs is that we don't have an industrial plan.
Yes.
Even UK CEOs.
Yes.
Do you see that coming as, again, Europe has to face the threats of Donald Trump?
The big elephant in the room in Europe is a lack of competitiveness, with two formidable regions called USA and China, right? So yeah, obviously the new Trump administration, nothing is surprising. It's going to be extremely efficient and aggressive, right? Wait and see. I mean, let's see how the tariffs are going to be, applied and executed. But Europe, it's a moment of truth for Europe. It's about Europe going from European with an ambition to be to the ambition to do. The Draghi report is out. The chemical industry, we were 73 CEOs gathering in Antwerp in Belgium back in February, making a cri du coeur, a call for action. Now there are 1,280 signatories for that declaration. And that declaration is very simple. We need a single market. We need a level playing field, because Europe is asking for more green solution. And by the way, we need demand for the low carbon solutions. And we need less bureaucracy and more simplification, amongst other policies, which has to happen. So it's time for action.
Well, do you think that will come? Again, the Draghi report asked for 800 billion euros, a lot of questions of where that came from. And I think after a couple of hours the report came, certain member states said, oh, that's impossible to put together.
Yeah, I know, it's tough. But at the end of the day, Europe is in a tricky situation because for us, we need energy. And the energy prices are much higher than in the US or in China. So we need that support and then infrastructure. Do I have hope? Hope is not strategy, but I'm optimist. And Miss President Ursula von der Leyen has named Stefan Sejourné, by the way, Commissioner on the Clean Industrial Deal, right? So, yeah, we have high expectations, I would say, that now we start executing to support the European industry. Now, for my company, I must say my demographics are a bit different because 41% of my revenues are in the Americas, and I'm very bullish about the US and stay bullish about the US, 35% in Asia, my smallest region is in Europe. But listen, Europe has to stand up local for local and support its industry.
You're also the president of the European Chemicals Association. What's the right way in dealing with Donald Trump as we start seeing how he expresses them on social media? I don't know whether that's policy or tactic.
Yeah. Well, listen, I'm the president of the European Chemical Industry and incoming president for the global Chemical Association in January. So our companies, our members, are very global companies, right? My company, as an example, ScienceCo, is acting local for local. Obviously, if there are tariffs, they will impact the flow of goods, imports of materials, exports of finished products. So we are planning for this, right? If it doesn't work well, it means increased prices, and with inflation, it can hit the consumer, spending and consumption. But at the end of the day, I really believe any administration would like to see a balance, right? Balancing acts, and that's what we expect. So what we expect now is that the authorities, they give us visibility about what's going to happen. Lack of visibility is not good for business.
I love how you put it, that you're the silent motor of a lot of companies.
Yes.
Because you're everywhere.
Yeah.
And not many people know about enzymes and things like that. I mean, it's also transportation. When you look at your supply chain, what do you worry about the most for 2025?
Yeah. So, I mean, first of all, for my company, 2025, we're, for example, in the business of sustainable aviation. And people, that's a business which grew most in a soft 2024. Very, very, excited about our world-class composite material. They make your aircraft lighter. And this is booming. There are 15,000 aircraft in the order book, right? It will take 10 years to build them with the build rate of 2023. So there is an opportunity for growth in lightweight material. We make your car, your e-bike, your aircrafts lighter. There is more demand for the energy transition solutions, right? So I'm very excited about those. But again, I've never seen in my 10 years of being a CEO, the geopolitics blurring with the economics as they are today. And that lack of visibility, this is what makes investors and business, community a bit skeptical or in the wait-and-see mode. And that's what we need. We need that clarity. But for our business, we have a strategy of local for local, and it has been working for us very well.
I mean, does the lack of visibility mean that there's less CapEx spending? Can you feel it, basically, in the investments?
If there is more bureaucracy, if there is lack of visibility from the environment perspective, from the permitting, like in Europe, there will be more CapEx flowing into the US, and IRA has accelerated some of it, right? So that's what we need. We need to align with the authorities on the how. They need to engage more with the business community and have, a favorable, economical friendly, environmental friendly environments with visibility to be able to invest in.
But Dr. Lam, where do you stand on, a lot of concern is coming from the fact that maybe there's a retrenchment when it comes to green policies. I mean, we're even talking about not being sure whether the US sticks to the Paris Accord. Does that change business views?
But I think, Europe has committed for carbon neutrality by 2050. My company, by the way, and many of my customers, we are committed by 2040 even. So we want to do it, right? It's not about the what, it's about the how. it's about the bureaucracy in the way. I mean, in my 5 years of being a CEO in Europe, there were 14,000 pages of regulations on our way, right? That's just too many. So I think we are calling for simplicity. Not even for money. I think funding is not that problem, because when we invest for 50, 60 years. We don't invest for one mandate, for one administration, right? So we need that visibility, that consistency, that dialogue. And I must say that's why I am optimistic that dialogue started with the new EU Commission. And the US has been very consistent in the way they protect their economy, and they're asking for more balance. And listen, for those people like us who have, big presence in the US, it's a good story for business.
Dr. Ilham, as always, thank you so much for joining us. Dr. Ilham Kadri there, the CEO of Ciensco. Now, we're just getting a little bit of breaking news, actually, an important one. Foxconn is said to pause the pursuit of Nissan as a Honda deal talks unfold. Now, this was a Bloomberg story that we broke a couple of days ago. We have an important interview also a little bit later on with Carlos Ghosn, who was for many years the CEO of Renault Nissan Mitsubishi Alliance. So this was a couple of days ago because of concerns. Our Craig Trudell, who's our expert when it comes to, of course, some of the cars, was saying, look, Nissan has a real problem in getting access to EVs, getting access to cars that then sell across the world. So we understand that there's this Nissan-Honda talks. We understood that Foxconn would be part of it. And now this Bloomberg story saying that Foxconn, for the moment, is going to pause the pursuit of Nissan. They are waiting to see how this potential deal with Honda plays out. So Carlos Ghosn, that exclusive interview coming up at 10:30 a.m. London time. Also coming up, Hungary's Viktor Orbán tells the EU to wait for Donald Trump before deciding on extending sanctions against Russia. We're live in Brussels with the latest next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Today, San Francisco Fed President Mary Daly sits down with Bloomberg Surveillance for an interview on the latest Fed rate decision. Tune in today at 7:30 Eastern, only on Bloomberg.
I'd like to suggest to the upcoming presidencies to be brave. Well, this was our slogan for our presidency: "Make Europe great again." This is our only chance. Thank you.
Well, that was the Hungarian Prime Minister, Viktor Orban, speaking at the EU Leaders Summit yesterday. Now, Bloomberg also understands that Hungary's Orban has told EU leaders that he wants to wait until the inauguration of his ally, Donald Trump, before deciding whether to extend the bloc's sanctions against Russia. Now, let's get more with Bloomberg's Oliver Crook. Ali, so how have EU leaders been reacting to these comments from Orban?
Yeah, so listen, Orban is sort of the usual disruptor-in-chief here for the EU on a number of different topics, but it gets sort of quite serious when it comes to this issue of Ukraine. And again, what we've heard from European leaders from the very beginning and reiterated again last night by Ursula von der Leyen, the main message today after this leaders' meeting was full support for Ukraine as long as it takes. That means trying to get some more artillery, some more ammunition, these sorts of things to Ukraine. There is, however, a sense that the full support is already behind Ukraine, and there isn't maybe much more that they can provide. However, now the concern becomes, is there something that they were going to have to subtract from Ukraine, particularly in the form of these sanctions because of Viktor Orban? Because how it works in Europe is that every sort of 6 months, these sanctions need to be unanimously by all 27 member states, be reiterated and brought back into force. All 27 EU member states, Orban and Hungary is one of them. He is basically saying that he will not roll those over until the inauguration of Donald Trump, which will happen on January the 20th. The deadline for that rollover is January the 31st. So this makes a lot of sort of concern for European leaders here. There is some discussion about potentially looking at other levers they could pull. Could they tap those frozen Russian assets, not just the proceeds, the underlying Russian assets? That is something that Dombrovskis have sort of been thinking about. But throughout this entire meeting, Francine, it's really just been the sort of Trump show looming very large over this, and basically everybody in Europe right now a bit in reaction mode to Donald Trump.
Yeah, but speaking of Donald Trump, is Orban really trying to position himself as the Trump whisperer?
Yeah, well, listen, Francine, I think he certainly has been for a number of years now, and it's a bet that has, ultimately in the end paid off, and it was quite a gamble for Viktor Orban. I mean, when we get these tweets from Donald Trump, we got one at 1:08 a.m. Eastern time saying that basically he told the European Union that they must make up their tremendous deficit in the United States by large-scale purchases of oil and gas. Otherwise, it's tariffs all the way. The question is, when he said he told the European Union, who is he talking to? Could it be Viktor Orban? Did he talk to Ursula von der Leyen? Is it Scholz? Is it Macron? This is really an open question. I think that on this specific issue, though, on oil and gas, the Europeans are already buying a lot more oil and gas from the United States. And frankly, since now we've learned in the last 24 hours that this Ukraine transit deal, so there's still about 15 billion cubic meters of gas that are flowing through Ukraine into Europe. That deal will die at the end of this year. Could that sort of shortfall, still 8% of European gas comes from Russia, could that shortfall be made up by LNG for the United States? And could that basically give Donald Trump what he needs in order to not impose tariffs here on Europe?
Ollie, thanks so much. Ollie Crook there with the very latest, of course, on Orban. Now, U.S. Secretary of State Antony Blinken downplayed concerns that members of President-elect Donald Trump's incoming administration are engaging in foreign policy before taking office. Now, he spoke to Bloomberg's David Gura about the transition process to his successor.
I want to be able to hand off to the incoming administration the best possible hand to play in all of these areas, in all of these challenges, because the world doesn't stop just because we're in a political transition. It's also normal that countries around the world want to hear from the incoming administration. They want to know what they can expect.
Now, earnings news, and Nike is down pre-market after the sportswear giant outlined its turnaround plan to reignite growth. Let's get more with Andrea Felsted from Bloomberg Opinion. Andrea, so what's going on at Nike?
Well, this is Elliot Hill's first big, public outing. He's set out a very sensible strategy, doing all the things we know it needed, more focus on sport, unleashing more innovation, reconnecting with the retailers again. But he also said he wants to take, Nike's own platforms, its stores and websites, much more to full price rather than discounting. At the same time, he wants to get rid of a lot of those unfashionable styles that they've been stuck with, and that's going to weigh on sales and profits in the current quarter.
So what happened? I mean, this is a tough task. How did it go so wrong for Nike?
So there were a few things that happened. It really, under John Donohue, it wanted to be a luxury brand. So luxury brands, they control most of their distribution. They sell very little through outside retailers. So that was Nike's strategy. So it sort of, disconnected its wholesale partners. So they didn't stick around. They filled that shelf space with other retailers on Hoka, Adidas. So consequently, they've all done really well at Nike's expense, and he's got to fix that. Then he didn't have enough new buzzy products. You know, Adidas with Bjorn Gulden's got a real, you know, merchant at the heart of that company. He figured out that these terrace styles were selling well, so he sort of, you know, went into that and supplied more of them. They've become the hottest sneaker. Nike's just out of fashion.
I kind of want to know what's on your Christmas holiday, you know, shopping list, Andrew. I mean, there's quite a lot going on with discounts. Are the next 2-3 weeks going to be really like make or break for a lot of companies?
I think they are. Now, I think there's something really interesting going on. I think the American consumer's actually in a bit of a better state than we are. I think the election, whatever anybody thought of the result, it did provide some certainty. It's out of the way. Until recently, the stock market's been doing pretty well. You've got crypto on a tear. That should help US sales. Okay, the lower end consumer is still under pressure, but you've got inflation, you know, falling, hopefully interest rate cuts. I think Europe is much tougher. You know, we've got, you know, particularly in the UK, we've got inflation higher for longer. The measures in the budget, such as the increase in employers' national insurance contributions, that's got employers thinking about jobs, thinking about pay increases, thinking about their employment levels, thinking about hours. Now, one of the things that got us through the cost of living crisis was the fact that anybody who wanted overtime to pay for their higher bills, it was there. That's not going to be there this time. So I think for European retailers, it's much tougher. I expect the winners to do well, and I expect the US to have a stronger Christmas.
Andrea, thanks so much. Andrea Felstad there from Bloomberg Opinion. Now, coming up, Brazil's Congress inches closer to delivering weakened key provisions of a spending cut package. More on that next, and this is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back, everyone. Now, the conversations that matter, the insights you need. This is the pulse. I'm Francine Lacqua here in London. Now, Brazil's central bank has spent $8 billion to try and stem the market rout triggered by President Lula's handling of the fiscal crisis. Now, for more on this, Bloomberg's Creighton Harrison joins us. Creighton, thank you so much again for keeping us up to date with the story. $8 billion, what does that get you? A little bit of market calmness, but not that much.
Yeah, at the very least, the real seems to have come back from its lows. It did close a little higher yesterday, so maybe they've staunched the bleeding for now. The outgoing central bank governor and the new central bank governor who's coming in both appeared yesterday and spoke for about an hour and a half, taking questions, and really tried to assuage the market that they do have the tools to contain inflation, that they're going to be able to do this. Of course, as we've been discussing, there's still this anxiety that at some point the central bank can only do so much, and what really needs to happen is the budget needs to be contained.
So Creighton, President Lula also has gone through massive surgery, actually, in the last couple of weeks. Today is his first day back where we're expecting to hear from him. What do we know about the relationship between him and the central bank?
Yeah, so as you've noted, he had a head injury that resulted in some brain bleeding. He had that drained. He is now back in Brasilia, supposed to be back today. And back at work, and he's supposed to meet with his ministers today in what would be his first public appearance since returning to work. So that's going to be a real crucial moment, because if he says anything to the press, if he says anything publicly, he could start things aflame all over again, or he could calm things down further. His relationship with the central bank is changing because, as I said, there's a change in leadership there. The new guy is his appointee, Mr. Galípolo, who is much more, has a much better rapport with Lula than the previous central bank governor, who was a Bolsonaro appointee. So that may help if they can coordinate a little more closely.
I mean, and your team on the ground has been speaking to a number of bankers. Who does Lula listen to?
Yeah, I mean, the situation is pretty dour there. I think people feel, that there's sort of at least an early cost here in terms of the foreign investment that they're worried may stop, the ability to invest in infrastructure and in growth, right? And capital expenditures may be limited these next few years as people try to send their money out of the country to wait out the rest of this Lula presidency and see what happens in the next election.
So interesting. Creighton, thank you so much. Bloomberg's Creighton Harrison, of course, who's in charge of our Latin America coverage. Later today, we speak with San Francisco Fed President Mary Daly on the Fed's decision and outlook for the next year. But up next, a Bloomberg Brief. This is Bloomberg.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed. get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them. Did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The reason I stopped it, well, I still play, but not as serious as I did when I was younger. But drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
FedEx shares jumped as much as 8% pre-market. The delivery company saying it's ready to spin off the freight division. What's it worth? Tesla down over 4%. ARC CEO and CIO Cathy Wood said she's selling more of the company's stock. Do bear in mind, this stock is up 75% since the inauguration and this year. In just a few moments, we'll catch up with Mads Peterson, Human Edge. And later this hour, Frank Monkum of Buffalo Bio joins me around the desk. Plus, that exclusive interview with Carlos Ghosn, former chairman and CEO of Renault, Nissan, Mitsubishi Alliance, as we have that breaking news that Foxconn are on pause after their conversation with Renault. Let's kick off these markets. Mads Peterson is the CIO for Human Edge Investment Technology, weighing in on the Fed's decision, writing this. The market needs a steady hand from the Fed. Powell delivered wavering metaphors. This is a recipe for volatility. Volatility is expensive, and the American population is now paying the price in the form of uncertainty about borrowing costs next year and beyond. He joins me now. Mads, if you look at the bond market, he didn't do a good job. We've tightened up. They're losing incremental control over this bond market, meeting by meeting.
Exactly. This is the problem. The market hasn't moved up that much that this is a real large problem yet. We have a natural correction in a strong equity market, and we have yields moving up. But what everyone fears and what we need to watch in the first quarter is that the Fed does not make a communication mess again as they did in 2022. The communication was unclear, the direction was unclear, and this increases volatility and makes it difficult for everyone in the US to run their economy, run their household, run their company. So we need a steady hand. We don't need a Fed chairman telling us that it's difficult to predict the future, that it's a tough job he has. These kind of conversations, they belong in a rock concert or maybe a pop concert with Taylor Swift. This is not the kind of communication for a serious central banker. He should give a steady hand, a short message, and he has 8 meetings more next year to communicate. So please get in line and tell us what he's going to do, easy and steady.
Will he last those 8 meetings? Just the context you've just laid out to me there, that's what comes to my mind. Do you think he'd last the road?
Depends on how much he seeks a conflict, because what they promised initially was we're not going to make forecasts based on the incoming president's policy. Yeah. What they then did this time was suddenly they ratcheted up inflation expectations dramatically. They changed their forecast, but based on 3 months of very steady economic development. The only thing which happened was that the president, the candidate who was leading in most of the polls for most of the year, won the election. So there's not a reason for changing the forecast that dramatically, but he has gone back on a promise which was not to do incremental changes back based on speculation about policy. So if he chooses to do conflict-seeking speculation about Trump's policy, he might not last. Obviously, Trump cannot really fire him like that, but he can make his life difficult, and that will be difficult for markets to handle.
Yeah, to be fair, he does sound pretty stoic about staying in the chair. Risk premia has been disrupted this week. I said to you, have they lost control of the bond market? I'm looking at the steepeners. I'm looking at the 10s. They're up 15 basis points, the largest weekly increase since 2023. Is this a healthy reappraisal of risk premia, or is it just everybody going, I'm off for 5-7 days, and I'm just going to trim back a little bit of risk?
Well, if we stand where we are now, it's a healthy reappraisal. If we take out the actual course of it, yeah, and just say markets go up 28% in the S&P, and it goes down 4 or 5, depending on where we are in the future, just while we speak here. That's healthy enough, and it's especially healthy that, for example, Tesla and MicroStrategy, which are used as volatility trades for amateurs, they are being tamed and corrected. So that part is healthy. The part which is not healthy is if Brazil has to live a year with 15% interest rates, going to 20, if Lula doesn't want to stop this thing, that's not healthy for emerging market, and the emerging markets are always struggling when U.S. yields are high and the dollar is strong. So that could be unhealthy. As long as high yield spreads stay tight, the situation in the U.S. is under control.
Do you think those high yield spreads do remain tight? I mean, they are so aggressively compressed along with investment grade, but we're priced to perfection in high yield, aren't we?
Well, we were priced to perfection on Monday. We're priced to near perfection now. Probably with the situation being that defaults have come down from 2% on a 12-month trailing to much closer to 1% now, means that the actual market for these things is looking fair with the growth picture we have. And it looks like a fair risk premium you get if you have a recovery rate of 40-50%, and you only have, now the default is below 1.2%, but if default stays below 2%, and that's what we will get if we get a healthy growth next year with inflation of 2.5% and growth between 1.5 and 3%. So they're priced fair to attractive because they're not so volatile, but not if we get a lot of volatility, and then people need to move out. For the time being, they're attractive. We have lots of positions in them. I have them in my personal portfolio. I have them in my funds. I have them in my mandates. I'm very happy with my high yield position.
Well, if you have them in your own funds, then that's a ringing endorsement for the fund. You talked about Brazil. I just want to understand to what extent there's going to be, you say that is a canary in the coal mine. The disruption in the real this week and over the past couple of weeks is the canary in an emerging market coal mine or in a dollar disruptive 2025 coal mine. We're just showing some of the emerging market currencies, Mads, at the moment. I just wonder, is this the start of a more tectonic shift in EM relative to the US dollar?
It's not a start because it's been a 5-year trend. The presidents of the various countries have told about their global influence as their financial market influence has been scaling back. And they should stop posing like that and do something with reforms. But if we look at in their own countries, if we look at the situation with the dollar's strength and the level of interest in the US combined with the Trump policy of confronting every country, every major country with a conflict in trade, that's a recipe for huge risk in the emerging market. Remember, China is only growing because they have a net export. Otherwise, there's not much demand, okay? And if we look at the real as the canary in the coal mine, China Vanke's bonds fell to 50. That's deeply distressed, and you're not going to get a recovery in that side of the world. So for emerging markets, we look at what does the developers trade at in Brazil, in China, and what does Brazil have to do? Because if Brazil needs to continue defending the exchange rate as they've done this week, then they can't afford it, and we are facing another emerging market crisis. But if they get over it in a couple of weeks, things can normalize, and emerging market assets are just going to underperform like this year, but not worse necessarily.
Mads, as we close out the year, and thank you for being with us throughout the year, you've been so on the money in terms of being long risk. You've not flinched once throughout your calls of 2024. How do you succinctly sum up where you want to be with risk on going into 2025?
I want to be fully invested for the time being. I am looking at mainly being in the US. In our more defensive portfolios, we prefer senior loans and high yield to US government bonds. And I want to spend the Christmas holiday where I'm going to go visit my family. I'm going to go skiing like most of the people in Europe like to do around this time. And I'm going to think about when is the time to reduce this risk and to reduce it significantly. Will we get a boom in the US economy based on a reasonable effort by Trump and Musk, or will we get a disruptive fight? That's what we're going to find out in January. And if we get the fight, we're going to go to neutral. We're going to sell 40% equities. We're going to reduce our high yield positions. But if things continue, we'll stay fully invested. The markets have been strong, but there's not huge excesses, and this correction here is healthy for the market.
Well, if the past 24 hours were anything to go by in terms of Elon Musk and Donald Trump, president-elect, and their political agenda, it's certainly going to be a bumpy old ride. Mads, happy Christmas, happy holidays to you. That's Matt Peterson of Human Edge Investment Technology. There are other stories trending on the Bloomberg terminal. Let me get you up to speed. FedEx, I mentioned them at the start, but they're planning to spin off the freight division into a separate publicly traded company within the next 18 months. This will allow the company to focus on its core business, and it could boost the performance of the stock by capitalizing on the rising valuations of the standalone trucking business. FedEx trimmed its full-year profit forecast due to weak demand, especially here in the US and its express unit. UK retail sales grew more slowly than expected in November, suggesting Christmas shoppers might not boost the economy in the crucial final months of the year. Consumers remain cautious in the wake of the Labour government's first budget, and the figures are also a blow to Prime Minister Starmer's growth ambitions more broadly. And the Bitcoin slide from its record high earlier this week extended to more than 10% at one point amid the reduced scope for looser US monetary policy. The downturn weighed heavier on smaller tokens like Ether and Dogecoin. Bitcoin is still up almost 50% since President-elect Trump's victory in November. Coming up, Donald Trump's party votes against him. The president-elect has had his first big test of lawmaker loyalty. More on the vote next on Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal?
Are markets too optimistic?
How do you worry about the things that are outside your control?
How does the current fighting completely stop?
I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Today, San Francisco Fed President Mary Daly sits down with Bloomberg Surveillance for an interview on the latest Fed rate decision. Tune in today at 7:30 Eastern, only on Bloomberg.
Very disappointing to us that all but two Democrats voted against aid to farmers and ranchers, against disaster relief, against all these bipartisan measures that had already been negotiated and decided upon. Again, the only difference on this legislation was that we would push the debt ceiling to January of 2027.
Speaker of the House, Mike Johnson, there blaming the Democrats for the failure of a temporary funding bill yesterday. Johnson blames the Democrats, but the Republican-led House voted the plan backed by President-elect Donald Trump. The rejection sets the stage for a potential U.S. government shutdown, with funding set to lapse tonight. Let's get more with Kate Ackley. She's in Washington. Kate, we understand they're still furiously negotiating. Now, when it looks, Johnson blames the Democrats, obviously not going for the debt ceiling extension. We need a plan C. You've got 38 Republicans who voted against this. This is quite a quantum and a core of Republicans that have really clearly defied Trump here.
Absolutely, and it does sort of give a preview of maybe what's to come in the next Congress with, you know, an extremely narrow margin. Republicans are almost always going to need Democrats to pass some of this difficult type of legislation, especially as it relates to funding the government.
Well, I mean, President-elect took to Truth Social late last night to threaten tariffs against the EU unless they buy more oil and gas. I mean, what are the details on this? Because, of course, you have the two preeminent women of Europe saying, you know, we're ready, Ursula von der Leyen saying she's ready to look at oil and gas. Christine Lagarde said, you know, let's be checkbook diplomacy about this.
Well, and they already, you know, buy a lot of the liquefied natural gas from the United States. You said, what are the details here? Well, you don't get a lot of details in a Truth Social post or a post on X, but presidents do have very wide authority over tariffs, and so that's something where, you know, a lot of times you see President-elect Trump say he's going to do something, and it's going to take Congress, you know, so it might stop it or make it harder for him to do. But tariffs is something that the president really would be able to implement and has wide authority over.
It's interesting, isn't it, that it was the one country which had been spurred any kind of narrative from the president. I mean, Canada, Mexico, very squarely lined up. I just wonder who exactly he was talking to in Europe that he made those suggestions to buy more oil and buy more gas overnight. Let's just round off with the theater of where you are in Washington today. This is nail-biting stuff. What is it that you think can get the Democrats, because this is going to take bipartisan resolution, is the general view out there. So what is it that takes the Democrats to vote for it and captures those 38 Republicans? Do you think that they will shift a majority of those 38 Republicans?
That's going to be hard. I mean, some of those Republicans, I was looking at the list. There's Bob Good, a Republican from Virginia. He's already been ousted in a primary, so he's not coming back next year. What does he care? Trump worked against him in his primary. So you have, specific examples like that where there's just a complete stalemate. You're not going to woo those Republicans to vote for something that they don't want to. But they said they were negotiating all through the night. We haven't had any signals that there's some kind of a deal. They were talking about a deal yesterday. It was really a deal among Republicans. Democrats weren't involved in that deal. You need Democrats to pass something. We're talking about the House. I mean, look at the Senate. Democrats still control the Senate for a few more weeks. So it's, you're right, it's a nail biter. It seems like we are on pace for the government to shut down overnight.
Well, before that vote, the Democrats were locked in a room chanting, "Hell no." So, it's going to be a very, very tough day ahead in Washington. Kate, thank you very much, Kate Ackley, keeping us abreast of the latest political moves right here on Bloomberg.
We're going to be talking about the Bank of England, what they're doing, and maybe more importantly, what they might be doing next year with interest rates in 2025.
Yeah, it's like the Bank of England is trying to send us a message, but it's like written in a different language or something. It's not quite clear what they're trying to tell us. The markets are saying one thing, but the bank might be thinking something else.
Yeah, and the thing is, they just decided to keep the bank rate right where it is at 4.75%. And, at first glance, you might think, oh, well, that's not very exciting, is it?
Mm-hmm.
But the markets were actually expecting maybe like 2 rate cuts next year. And then the Bank of England governor, Andrew Bailey, kind of threw everyone a curveball. He came out and said that maybe 4 quarter-point cuts in 2025 might be more appropriate. It's like, well, hold on a second. What's going on here?
Oh, right. Yeah, it seems like everyone's on a different page. And then to make things even more interesting, it looks like 3 members of the Monetary Policy Committee actually voted against keeping the rates the same. They actually wanted to cut rates right now.
3 of them, huh? So who are these 3 and what's their deal?
Well, you got Dingra, Ramsden, and Taylor. Ramsden has been pretty vocal for a while now, saying that he wants to cut rates. He thinks the economy needs a little help and that cutting rates is the way to do it. Dingra is more worried about how high inflation is hurting people, especially those who don't have a lot of money. She thinks that cutting rates could give some people a break. And Taylor, well, he's got a slightly different angle. He's more focused on the possibility that the economy might slow down, and he sees cutting rates as a way to kind of give things a little push and keep things moving. But the fact that all 3 of them disagreed with the decision to keep rates steady, well, that tells you that there's some real debate going on inside the MPC about what the best move is.
Okay, so it's like, got this kind of internal battle going on at the Bank of England. You got the folks who are saying, hey, let's be careful and take it slow. And then you got others who are saying, no, we need to do something now. And it kind of makes you wonder who's got the right idea. Are they being too cautious, or are the ones who want to cut rates jumping the gun?
That's a great question. And to try and answer that, the article we're looking at brings in a few experts. They try to weigh in on this whole debate, like Stefan Koopman from Rabobank. He thinks the markets are totally off base. He thinks the MPC is actually getting ready to cut rates way faster than anyone is expecting.
So he's on the side of let's cut them faster, huh?
Exactly. And he's not the only one. Konstantinos Vanettis from TS Lombard seems to agree with him. He's even using phrases like deeper rate cutting cycle. which makes you think that maybe this is going to be a bigger change than we thought at first.
Okay, so faster and deeper cuts. Got
Yes,
it.
yeah.
But here's the thing I'm wondering about. When are these cuts going to happen? Are we talking about a big sudden change or more of a gradual thing?
Yeah, that's where it gets even more interesting. Sanjay Raja, he's a UK economist at Deutsche Bank. Well, he's also predicting 4 cuts next year, but he thinks they'll mostly happen in the second half of the year, kind of like waiting till the end to make the big move.
Ah, so a backloaded approach. That's like waiting for the perfect moment. Right? But why wait?
Well, he thinks the Bank of England is playing it smart. Like they're saying, let's just see how things go and then we'll make a move. They're waiting for certain signs from the economy before they really start cutting rates.
Okay, that makes sense. So what are these signs that they're looking for? What's going to tell them that it's time to start chopping those rates?
Well, Raja specifically mentions things like unemployment going up over 4 or 5%, and wage settlements cooling down, meaning that wages aren't growing as fast anymore. And services inflation coming down too. It's almost like they have this checklist, and once they check off all the boxes, then they'll feel good about cutting rates faster.
So it sounds like a slow start to the year, and then maybe things pick up speed in the second half. But it's not just about the timing, is it? It feels like they're trying to do 2 things at once. They want to help the economy grow, but they also don't want to mess things up. It's kind of like they're walking a tightrope.
Yeah, exactly. It's a tough balancing act for sure. On one hand, they want to loosen things up a bit and give the economy a little boost, but they're also worried about spooking the markets or accidentally causing problems. It's like trying to steer a giant ship. You can't just make sudden turns. You got to be careful and make changes gradually.
It's funny you should say that because I was just thinking about how this affects us. You know, regular people just trying to manage their money. I mean, we're not the ones setting interest rates. But all these decisions from the Bank of England can have a real impact on us, like our mortgages, our investments, all that stuff.
Oh, absolutely. And that's why it's so important to understand what these potential rate cuts could mean for you and your finances.
Okay, so let's get practical here. If the Bank of England does decide to speed things up in the second half of 2025, what could happen? What should we be watching out for?
Well, one thing that could see some big changes is the housing market. Lower interest rates usually make mortgages easier to afford, and that can lead to more people wanting to buy houses, which could push prices up. So if you're thinking about buying a home, these rate cuts could be a big deal.
But hold on, wouldn't that also mean that housing could become even less affordable for some people? Like the ones who are already having trouble getting into the market. Wouldn't that just make the gap between homeowners and renters even bigger?
Yeah, that's a good point. It's kind of a two-sided coin.
It could help some people get into the market, but it could also make things harder for others.
And we might even see people start buying houses just to try and make money quickly, which could create a bubble that eventually bursts. Definitely something to keep an eye on.
Okay, so good news for some buyers, maybe not so good for others. Sounds like a mixed bag for the housing market. What about investments? How could these rate cuts affect things like stocks and bonds?
Well, historically, when interest rates go down, stocks tend to look more appealing to investors. That's because when rates are low, investors start looking for other places to get higher returns, and the stock market often seems like a good option. So we might see certain sectors do really well after these cuts, especially the ones that are sensitive to changes in interest rates.
So does that mean people should start moving their investments around?
Well, it's not quite that simple. Remember, investing always has risks. And we got to keep in mind that the Bank of England is making these decisions based on what they think is best for the UK economy. But that's just one part of the whole picture. Things happening around the world, unexpected events, all sorts of stuff can throw things off.
Right, it's like trying to predict the weather. You can look at the forecast, but you never know when a storm might pop up.
Exactly. So yeah, while these potential rate cuts might create some good opportunities, it's super important to stay informed, do your research, and understand the risks. Don't just jump into anything without thinking it through just because you hear interest rates might be going down.
So stay alert, do your homework, and don't put all your eggs in one basket.
Got it.
But sometimes I think we get so caught up in all the numbers and predictions that we forget about the people involved. These economic decisions have real impacts on people's lives, on their hopes, their worries, their ability to just make ends meet.
You're absolutely right. And that's what makes this whole discussion so interesting and honestly a little bit scary too. We're talking about real people's livelihoods here.
I mean, imagine you're a young couple trying to save up for down payment on your first house. These rate cuts could be amazing, or they could be a total disaster. It all depends on how the market reacts. Or think about someone who's close to retirement and counting on their investments to give them a steady income. These changes could have a huge impact on their financial security.
Yeah. That's a really important point. It reminds us that this isn't just about abstract economic ideas. These decisions have real consequences for people and families all over the UK.
Exactly. So as we're trying to figure out this whole economic situation, it's important to remember that there are real people behind all these numbers. Their stories, their hopes, their struggles, they're all connected to these economic forces. And even though we can't predict the future for sure, we can at least try to understand what might happen because of these decisions, and then make smart choices that work for us and our goals.
It's kind of like trying to walk that fine line, you know? Keep everyone happy, but not make any sudden moves.
Yeah, it makes you think about how all of this connects back to us. Regular folks trying to manage our own money. We're not setting interest rates or anything. But these decisions from the Bank of England, they can really affect us. Everything from our mortgages to our investments.
Absolutely. And that's why it's important to try and understand what these potential rate cuts could actually mean for your own personal finances.
Okay, so let's get down to it. If the Bank of England does decide to speed things up with those cuts later in 2025, what could happen? What should we be looking out for?
Well, one area that could see a lot of action is the housing market. Usually when interest rates go down, mortgages get a little easier to afford. And that can lead to more people wanting to buy houses, which could push prices up. So if you're thinking about buying a home, these rate cuts could be pretty important.
But wait a minute, wouldn't that also mean that housing could actually become less affordable for some people? Especially those who are already struggling to get into the market. Wouldn't it just make that gap between homeowners and renters even wider?
Yeah, that's a valid point. It's kind of a double-edged sword, you know? Lower rates could help some folks get into the market, but it could also make it even tougher for others. And we could even see people start buying up houses just to try and make a quick profit. That could create a bubble, and we all know what happens when bubbles burst. Definitely something to pay attention to.
Okay, so good news for some buyers, maybe not so good for others. Kind of sounds like the housing market could be a bit of a roller coaster. Now, what about investments? How could these rate cuts affect things like stocks and bonds?
Well, historically, when interest rates go down, stocks tend to become more attractive. Investors start looking for places to get better returns, and the stock market often seems like a good bet. So we might see certain sectors do particularly well after these cuts, especially the ones that are really sensitive to changes in interest rates.
So is this a sign that people should be thinking about changing their investments?
Well, hold on a sec. It's not that simple. Gotta remember that investing always comes with some risk, and the Bank of England is making these decisions based on their view of the UK economy. But that's just one piece of the puzzle. There are things happening all over the world. Unexpected events could pop up and throw things off.
Right, it's like trying to predict the weather. You can check the forecast, but you never really know when a storm might roll in.
Exactly. So while these rate cuts could create some good opportunities, it's really important to stay informed. Do your research and understand the risks involved. Don't just jump into anything without thinking it through, just because you hear that interest rates might be going down.
Okay, so stay informed, do your homework, and don't put all your eggs in one basket. Got it. But sometimes I feel like we get so focused on all the numbers and forecasts that we forget about the human side of things. These economic decisions have real consequences for people on their hopes, their anxieties, their ability to simply get by.
You're absolutely right. It's what makes this whole topic so fascinating and honestly a little bit unnerving too. We're talking about people's lives here.
I mean, imagine you're a young couple trying to save up enough money for a down payment on a house. These rate cuts could be a huge help, or they could really throw a wrench in your plans. It all depends on how the market reacts. Or think about someone getting close to retirement relying on their investments to provide a steady income. These changes could have a big impact on their financial security.
That's such an important point. It reminds us that these aren't just abstract economic theories. These decisions have tangible consequences for real people and families all across the UK.
Absolutely. So as we try to make sense of this complex economic situation, it's crucial to remember that there are real people behind all the numbers. Their stories, their hopes, their struggles, they're all interwoven with these economic forces. And while we can't predict the future with absolute certainty, we can at least try to understand the potential consequences of these decisions and make informed choices that align with our own values and goals.
Yeah, it really makes you think, doesn't it? It's like we've got this puzzle with all these moving parts. The Bank of England's trying to find that sweet spot between boosting the economy and keeping things stable. Experts are making predictions that could send the housing market through the roof or leave some buyers high and dry. And then there's all of us just trying to figure out how to manage our money with all this uncertainty going on.
It's definitely a complex situation, but that's why we're here, right? To try and shed some light on things and help you, the listener, make smarter decisions. Exactly. So as we wrap things up, is there one key takeaway that you want our listeners to remember? What's the one thing they should keep in mind as they try to navigate all of this?
Well, I think the most important thing is that this situation is always changing. The Bank of England has given us an idea of what they might do, but things could easily change. The market might be underestimating how quickly and drastically the bank might act, and that could have a big impact on everyone.
So it's not just about whether they'll cut rates, it's also about how fast they'll do it and by how much.
Exactly. And those factors could ripple out and affect all sorts of things, from house prices to how people invest their money. It's like a chain reaction, one move leads to another. But it's important to remember that nothing is set in stone. There are lots of things that could happen and things can change quickly.
So we're talking about possibilities, not guarantees.
Right.
So what would you say to our listeners? How can they stay ahead of the game and make sure they're ready for whatever comes next?
Well, first of all, stay curious. Keep an eye on those economic indicators we talked about, like unemployment wages and inflation. Those are the things that will give you clues about what the Bank of England might do next. And don't just rely on headlines, dig a little deeper. Try to understand why these decisions are being made.
It's like being an economic detective, looking for those little clues that tell you what's really going on.
Precisely. And maybe most importantly, think about how these potential changes could create opportunities or risks for your own personal finances. Are you thinking about buying a house in the next year or two? Are you investing for retirement? The decisions the Bank of England makes could have a real impact on your goals. So take some time to consider how these changes might affect you personally and adjust your plans if you need to.
It's all about being proactive, taking control of your financial future instead of just reacting to whatever happens.
That's the idea. Knowledge is power. The more you understand about these economic forces, the better equipped you'll be to make informed decisions that work for you.
Well said. This has been a really insightful deep dive. Thanks so much for helping us navigate these choppy economic waters.
It's been my pleasure. I always enjoy exploring these topics, and I applaud our listeners for taking the time to stay informed.
And to our listeners, we encourage you to stay tuned for future deep dives as this story continues to unfold. The economic landscape is always changing, and we'll be here to help you navigate it every step of the way. Until next time, stay curious, stay informed, and stay ahead of the curve.
Tough, but on the long term, they can save on future investment by doing the investment one time in technology, doing it one time, and sharing it with 3 companies.
Let's just press a little bit more on this. It's going to be tough, as you say, to get the synergies. It's driven by the Ministry of Economy. So there's a political dynamic to this. Is this Japan creating, putting 2 companies together to really try and stand up to the competition from China? Is that part of the narrative here, Carlos?
Without any doubt. It makes a lot of logic. Today, the Chinese automaker are on the winning side. They became, as you know, the largest exporter of cars. They are the largest maker of EV. They are being successful in a lot of new technology. They're doing fine cars. So in a certain way, yes, it's a defensive mood. It's a defensive mode that's going to be trying to shore up the Japanese industry and avoiding a cataclysm, first a social cataclysm in Japan, and particularly to try to reinforce these companies on the foreign markets.
Foxconn have put on pause their interest in participating in this deal, Carlos. They had a meeting with Renault. It obviously didn't go according to what they wanted. Is there only a Japan solution for this? Is there only a Japanese savior for Nissan, in your view?
I don't see him for the moment. Obviously, in the team existing today at Nissan, usually you can measure the team by the results they get. That's the only way you know if somebody is capable of doing something. Frankly, when you look at the last 5 years, the results are not a good testimony of the strengths of the team. Will they be a savior? I don't know. I know how tough it's going to be because you need to understand that Honda is an engineering organization. It's very strong in engineering. And Nissan is very proud of its own engineering. So the battles here to try to decide what technology is going to be adopted by the new company or by, if it's a merger, or by the new alliance, I can tell you it's going to be very tough. I've been dealing with this for many years. I remember when we took control of Mitsubishi, Mitsubishi was not afraid of the collaboration with Renault. They were afraid of the collaboration of Nissan because they know how tough it's going to be when engineers meet together. And there is this pride of my solution is the best solution, which always is an obstacle to develop serious synergy for the future.
Well, of course, you're going to have cultural issues when it comes, even if they're two Japanese firms. I think the point I was trying to get to, Carlos, was do you see the only solution being a Japanese to Japanese merger or joint venture? Do you see any possibility of an overseas company like Foxconn being allowed into this house?
Well, the approach of Foxconn, when I heard about it, was very interesting because it is something innovative. It is something that would have put Nissan in a completely different path. But the fact that you're telling me now that they are posing on it, they are very realistic people. They know they cannot do it against the will of the government of Japan and particularly of the Métis. And now you need to know also that in Renault, the French state has a big say because they are a very influential shareholder in Renault. And I'm sure that the decision of pose is coming from the fact that they know the Métis is not very favorable, and probably the French government doesn't want to upset the Japanese. I've been witness of how much the French government is bending backward to please the Japanese in the past, unfortunately.
Well, look, I know that there's ongoing issues between yourself, the Japanese, and the French, etc. But you have a ringside seat at many of those meetings. Is this, briefly before we talk about the global auto industry, Carlos, is this Renault's moment to exit? Do you think that that's what they hope for, or do you think they really do want an equity participation?
Oh, no. I mean, this alliance has been, since 2020. It's not a surprise. I told you that the alliance is a zombie. It's an appearance of an alliance. There is an appearance of a collaboration, but there was practically no collaboration at all. I think what Renault, after having the benediction, the blessing of the French government, is trying to maximize its asset inside Nissan. They're trying to get the most money out of their share. But that will, in my opinion, that will sell to Honda without any doubt.
Carlos, let's just broaden the conversation a little bit. You've lived and breathed this industry. You've seen the evolution of the Chinese electric vehicle market, the strength of the auto industry in China become. Are you surprised about how strong they've become so quickly?
No, not at all. You know, frankly, I've seen the signs of it when we entered China, when I was heading Nissan and we entered China in 2003 and we started building our plants and organizing the engineering. In a very short period of time, I would say 7 or 8 years after we built the plants in China, the Chinese plants were at the top of the ranking from all our plants. I mean, we were comparing the productivity, the quality, the time to market of the Chinese plant compared to the Japanese plant or to the US plants or the European plants. And the Chinese came to #1. It's a very disciplined workforce. They are very, very eager to compete into this industry. So I think this industry in the next 20 years is going to have to deal with the Chinese talent and the Chinese know-how.
Well, Carlos, you were known as Davos man, I think. You were the voice of free trade every January. The world is bracing for a next round of trade disruption from Donald Trump. Every CEO of an auto company out there probably has their own personal thoughts, but they probably can't really express them. You can. You're free now. As the auto CEOs line up, what can they not say? What do you think they're thinking, but they can't say?
Look, if you... that means this is an industry which is, by definition, a global industry. You can't survive as an automaker if you are restricted from accessing any market in the world. Size matters. Investments are huge. Economy of scale are extremely important. So this industry is living on globalism and globalization. So I think it's very bad news for all the automakers to know that there are going to be tariffs and there are going to be obstacles for them to be present in all the market. This will translate into a lot of them having problems and certainly a higher price for car in all the markets.
Do you think you'll see a major auto failure in 2025, Carlos?
Well, you know, there is no auto failure. There are, in a certain way, companies that are so weak that somebody else comes and buy them. When you look at the market capitalization of Nissan today, it's really very small. And I can understand that the company like Foxconn, headed by very serious and realistic management, is going to say, you know what, instead of us investing to do our own electric car, let's buy a car company. They're not going to be the only one to try to do that. Instead of building something from scratch, you can take control at a relatively cheap price of an existing car manufacturer, get rid of everything you don't need, and really concentrate on what's important for you for the future. I'm expecting a lot of moves like this in the future, particularly for the weaklings of the car industry.
Carlos Ghosn, thank you for joining me this morning. A candid conversation. Carlos Ghosn, the former chairman and CEO of Renault-Nissan-Mitsubishi Alliance, who served as the Nissan CEO from 2001 to 2017.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
In case you missed it, on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared than in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
It's Bloomberg Brief. I'm Manish Krani in New York. We have a little bit of breaking news for you on Novo Nordisk. These are the markets. You've got S&P futures down by 0.7%. So it's off the lows of the day. Quick snapshot of Novo Nordisk. They have a breaking news line here. Novo Nordisk says patients on their weight loss drug, CagriSema, lost 22.7% of weight in the trial. So we're trying to understand the comeback on this, showing superior readings in weight loss in adults with obesity and overweight. So we'll come back to that in a moment. As I say, Frank Munkham is my next guest, head of macro trading strategy over at Buffalo Bio Holdings, writing this: the Fed finally surrendering to cater to the bond vigilantes, introducing the risk of a stop-go policy. We'll come to the end of that week. Frank is around the desk with me this morning. Frank, it's been a really, really tough week. The market dislocated in equities, bonds, high yield. You would say that this is a form of stop-go policy. Just how much of a pause do you think we're going to get? Is that what's dislocating this market, or is it something else?
No, for sure. Thanks for having me, man. It's happy holidays. Clearly the Fed has kind of rained on the equities parade here going into the end of the year. And, I think what's really going on is the Fed has shifted a little bit here from being data dependent, to be honest, to being more of a forward guidance Fed here in anticipation of what's happening, with the Trump administration coming in with a tariffs policy. I think they're really trying to preempt the risk of having an inflation flare up here. But the risk, like I said, is to really have a stop and go policy here, because we don't really know what those policies are really going to look like. When you have new policies coming in, you have to kind of go through the process of having policies being designed, implemented, and the timing and also the sequencing of those policies. So I don't think we're quite there yet, but the Fed really is running the risk of kind of stopping and going here, because it is a great chance that once the Trump administration actually comes in and we realize that, yes, the direction of travel in terms of the policies are clear, but the distance and the speed of travel might not be what the Fed is anticipating right now. They might not start to talk a little bit more dovishly, and that's really the risk of having a Fed that's really ushering more volatility in the market rather than calming markets here.
Matt Peterson was with me a little bit earlier. He said, look, man, this is a natural correction that we've had, a natural moment of reprieve in these markets. How would you characterize this closing week of risk off?
Listen, the equities story in the U.S. continues to be fundamentally bullish. I think there's some underpinnings there that continue to be bullish. I mean, the U.S. exceptionalism, we still got about $6.7 trillion of cash on the sidelines. We're expecting over $1 trillion of buybacks. But when you have a market that's this overstretched in terms of conditioning and sentiment, and with valuation being where they are at 22 times PE, you're just running a higher risk of seeing a correction. And all it takes is really a catalyst. And I think the Fed's surprise hawkish cut yesterday just triggered that. And we had a huge gamma squeeze in the deals community. Gamma meaning options market parlance. It's volatility spikes. Dealers are short gamma, so they have to continue to sell to cover the short position. So I think this was bound to happen at some point. We thought we were going to go through a little bit of a Santa Claus rally here and maybe have some choppiness early in the year, but it came in a little early, and that's just par for the course when it comes to a market that's overstretched.
Who's the bigger steepener, Frank? Is it President-elect Donald Trump or Jay Powell? Because they both create heckishly steep bond markets.
Absolutely, and I think it's going to be very interesting how that dynamic is going to play out next year, because I think there's really going to be a tug of war between those two. We're probably going to have a shadow Fed in incoming Governor Walsh. I think that's the Trump's nominee here, and it's going to be very, very tricky. And going back to what I was saying earlier, that the risk of flip-flopping is going to be even more accentuated by the fact that I think the Trump administration is going to put a lot of pressure on the Fed to remain dovish, right? So it's going to be interesting to see how that dynamic plays out.
Would you say that next year is a year of two halves, which is, there's policy kites to fly, and then there's execution of those policies, whether that's tax and the tariffs and the deportations and immigration. So policy effect is perhaps more back-ended at the back end of 2025 rather than the front end.
Absolutely, but I think it's going to be really a two-phase process as we try to navigate, next year. This is the time of the year, end of the year, everybody's having the Christmas parties and trying to roll out these investment outlooks for 2025. But these investment outlooks really aren't going to mean anything until we get to probably early Q2, right? Because the first 100 days of the administration is going to be all about trying to figure out what the policy agenda is going to look like and how to really navigate through that. So I think the first 3 to 4 months are probably going to be super choppy, and it's probably going to require a lot of tactical trading. And then from that point on, I think investors are going to have more visibility on what the policy outlook looks like, and then you can have a more a comprehensive strategy as to how you want to position yourself for the rest of the year. But yeah, I mean, it's going to be a two-phase process here for investors in 2025.
Frank, thank you very much for being with us this morning. Happy holidays, happy Christmas if you celebrated there. Frank Monkham of Buffalo Bayou Holdings. I gave you some breaking news just as we came back before we started the conversation with Frank. Let's just recap on Novo Nordisk. The stock is down 19%, the most since 2016. The drug maker said that patients on what was an experimental obesity medicine, and that's CagriSema, achieved 22.7% weight loss. So it's a question of where that is to benchmarks. I can tell you this, Eli Lilly is jumping after the Novo Nordisk. I mean, these GLP-1s, this entire industry is, you know, as you can see, hugely volatile in terms of the data that is released.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Let's take a look at the rest of the day for you. An exclusive interview with the San Francisco Fed President Mary Daly at 7:30 a.m. Data, all important. We're going to close out with a PCE. That's at 8:30 a.m. And then you've got the UMIDge consumer sentiment at 10 a.m. So those last pieces of the inflation jigsaw, there's a lot of angst in this market. I can tell you we've bounced from our lows on the S&P 500 from the Bloomberg Brief team. Have a happy holiday.
office and a company called Company I Limited. I also have a live streaming channel for startups. It's SG Trader, so we let startups to pitch investment community on our channel. I give them 3-minute pitch. We publish their video on our channel, and everybody who is interested, please welcome to send me your video, and I will roll for almost a month your video for all financial community. The channel is live, it's streaming live 5 days a week, from morning till night.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Nasdaq 100, we are lower by 1.3. On the S&P, a record streak of negative breath.
14 straight days of more losers than gainers at a time, where people are wondering, is this just this respite, sort of the take back before early next year when they're expecting some sort of boom? A question now, though, of whether there has been a shift in tone because of the Fed, given that we aren't necessarily going to get that inherent easing bias throughout 2025.
We talked about this a lot yesterday, how we were set up going into that Federal Reserve. Let's go back to the start of this week. Feels like a long time ago. Bank of America put out their Global Fund Manager Survey, called it super bullish. Record low allocation to cash, record high allocation to US equities. That was the setup to that hawkish shift from the Federal Reserve on Wednesday.
That's really important, and I think it's really great that you bring that up, because at a certain point, can we really say that this is a dramatically different tone from the Federal Reserve, or just simply a market looking for any excuse to take a breather after such lofty heights? Look at some of the biggest losers over the past couple of days. They are the likes of Tesla. They are the likes of Bitcoin. They are some of the largest gainers post-election that maybe the froth is just coming off the top.
Let's head over to Europe. Euro dollar right now bouncing off a 2-year low. Euro dollar 103.90. Europe's got enough problems. Here's one more. Donald Trump, President-elect, out on Truth Social. I told the European Union that they must make up their tremendous deficit with the United States by the large-scale purchase of our oil and gas. Otherwise, it's tariffs all the way.
Okay, I read this and then I looked back and I was like, wasn't there a pause, a ban on the licenses to sell LNG over to Europe? Oh yeah, that's right, this administration. This is a Europe that has faced fickle U.S. policy when it comes to whether they want them to buy their LNG, their liquefied natural gas, or not, whether they want them to really be taking up some of the resources. So here's the question. How much does Trump actually effectuate this with respect to jawboning Europe versus just increasing production in the U.S. at a time where backdrop policies have been shifting and back and forth over the past couple of years.
So here's the good news for the Europeans. The Europeans are already there. Ursula von der Leyen came out as soon as Trump won the election and basically said, we'd like to buy more liquefied natural gas. This is what they want. Here's the bad news. I don't think that's going to be enough to close the trade deficit. You're going to have to do a whole lot more than that. So that's where I think there's going to be some space for a little bit more tension in the years to come.
Well, and the tension increases because the dollar is so strong. So any exports from the U.S. are going to be incredibly expensive for a lot of these places. Meanwhile, I just wonder how much cohesion there is among the Republicans themselves at a time where they can't really get themselves together and keep the government open so clearly. So a real question here about what policies actually do get passed.
Are we really going to get shut down going into the weekend?
I honestly have no idea. The good news is they took a 1,500-page bill and they took it down to 116. They took out some of the wage gains for some of the Congress members. The bad news is that they couldn't get a lot of their Congress members within the Republican Party to sign off on it. And basically, you have the situation where House Speaker Mike Johnson came out and said, if any of you can do better, please have at it, because that was his message.
I'm happy they've sliced up the bill, and this is why. They can all stop pretending that they read bills, and they can actually start reading them. Because there is no way that these people read those bills that are that long in like this amount of time, just days. There's no way they do that.
Okay, but that was the only thing that they accomplished. I think that Representative Chip Roy, who is a conservative from Texas, really put it well when he said to congratulate yourself because it's shorter in pages, but increases the debt by $5 trillion is asinine.
Anne-Marie down in Washington, D.C., a little bit late to this hour. She'll join us in about 15 minutes' time. If you're just joining the program, welcome. Equity futures on the S&P 500 adding to the slide. We're down by 0.8% on the S&P. The good news, I guess, for the equity bulls, in a bear market, in a bond market, at least we're not climbing any higher for 10-year government bond yields. Yields are lower by just 2 basis points on a 10-year, 4.5362. Coming up this hour, we'll catch up with Joe Quinlan of Merrill and Bank of America, remaining cautiously bullish. We'll speak to Doug Redeker of International Capital Strategies as a U.S. government shutdown continues to loom, and Christian Weatherby of Wells Fargo as FedEx plans to spin off its freight division. We begin this hour with stocks falling as traders weigh the threat of a U.S. government shutdown and await the last major data point of the year. Joe Quinlan of Merrill and Bank of America Private Bank remaining bullish, but proceeding with caution. Stickier than expected inflation and therefore fewer Fed rate cuts than anticipated could cause the bull market to stutter or stumble. Joe joins us now for more. Joe, is this a stutter or a stumble?
I think more of a stutter, John. I mean, actually, I thought this was going to happen in January. We moved it up before Christmas. So, the stickier inflation theme is something that our economists have been talking about for quite some time. We saw through the numbers. We got the PCE later today. So I think this is a wrestling match that we're going to have to deal with over the course of 2025. But look, inflation is not 2%, but it's under 3%. So that's a nice place to be in terms of the overall market.
So, Joe, the Federal Reserve is increasing their inflation forecast. You saw that on Wednesday. They had to adjust the dot plot off the back of that. I just wonder whether that reshapes your view of how much risk you want to be carrying into 2025.
It didn't change anything really, John, in the sense that we've got a good economy, good consumption. If you could convince me this economy was going to slow down dramatically for whatever reason, we changed our bullish outlook. But look, we've got a good employment. We've got a CapEx cycle underway. Higher income households are still out there spending. So you've got a good nominal growth, which means you've got a good backdrop for earnings. We're still looking for earnings around 13% year over year in 2025. That hasn't changed.
At the same time, Joe, because we've taken some of the froth off the top of some areas that had been the high flyers, does that make you more bullish?
It makes me more comfortable, Lisa, for sure, because for the last, say, a week or so, our clients have just been flabbergasted by the enthusiasm in the markets, and they've become increasingly worried. So this pullback, I think, is refreshing. It sets us up for better, healthier 2025, whether it's January and February. So no, I take comfort in this pullback because, there's some sanity to the market in terms of some of these valuations and the over enthusiasm.
I'm going to use that, Joe, throughout the day when people talk about the sell-off and how concerned they are. I'm going to say it's refreshing. That's what Joe Quinlan said. It is a refreshing sell-off. I do wonder how you sort of weigh the backdrop of a U.S. government that may shut down with haggling over whether or not they get their first raise in a decade and also just the number of pages in the bill. I'm wondering, does that register in the sort of different panoply of risks that you're looking at?
Not really, Lisa, in the sense that you know this as well as I do, as do investors. Government shutdowns, they've happened before. We know the script. They can be hours, they can be days or weeks. They're going to reopen. We're going to get the continuing resolution. We're going to pay our bills. So, yeah, it's drama that we really don't need in and around the holidays, but it's here. And if we do shut down tonight, they've got the weekend to work through. Hopefully, they're open by Monday. So it doesn't really fundamentally change our view. But, you know, like you said earlier at the outset, if we went from a massive bill down a few pages, maybe that's progress. Maybe we count the progress by the number of pages of the bills.
That might be where we are, Joe. I'm not as worried necessarily about a government shutdown and how long it takes for them to get the government open. There's a bigger point here, which is some people were saying that with a red sweep, there would be a faster path to policymaking. Actually, a quicker and more effective Donald Trump administration to pass some of the more growth-oriented policies, given the fact that a host of different Republicans did not vote for this bill and did not go with the president. How concerned are you that that whole case that's been baked into some of the optimism isn't reality?
That was part of my note I put out about, you know, what worries us into 2025, because you have to realize the gears grind slowly in Washington, right? There's a New York minute and there's a Washington minute, and they're night and day. So absolutely, Lisa, we've been talking to our clients, say, listen, when it comes to the tariffs, anti-immigration, corporate tax reform, you name it, this is going to take months, if not quarters, if not all year. So kind of curb your enthusiasm. We have it built into our expectations, some of our asset allocation. But you're dead right in the sense that the gears there are just not as fast as Wall Street. There's a big difference.
But Joe, just to jump in, sir, if I may, you can get the tariffs done a whole lot quicker than you can get the taxes done, just by definition.
You can, John, but even that takes time to like layer in and get implemented. But you're right, for sure.
Sure. So they're going to come out January 20th and potentially start doing it almost immediately, saying we're going to do 1, 2, 3. Is that the sequencing that you expect? Because sequencing seems to be important to a lot of investors for next year and beyond.
I think the sequencing is going to be important, but also the targets, right? If we're going to come right out of the gate and go after China, how does China react? That's going to be important. You talked earlier about Europe. So I think, you will know the priorities of the administration right out of the gate. And everyone does expect it to be China. But then, John, then you got to go, okay, what products, how much, what industries? There's a lot of U.S. companies are working behind the scenes with the incoming administration, to go easy, to protect what they have in terms of their supply chains. So, yeah, it's going to be very interesting, but I don't think it's going to happen overnight either.
Hey, Joe, good to hear from you. Enjoy the holidays. Merry Christmas, sir. Joe Quinlan there of Maryland Bank of America Private Bank on the latest. It looks like the focus at the moment seems to be on tariffs and spending cuts, based on where the focus has been over the last few weeks.
And as you point out, tariffs might be a lot easier to get through than, say, spending cuts if cutting down the number of pages of a bill might be the progress, but not necessarily getting that bill passed.
I'll tell you one thing losing some weight this morning. It's the market cap of Novo Nordisk. That stock is getting absolutely hammered. We're down by 22%. Let's get you an update on that and more with Yahara Hacker. So, Yahara.
Hi, John. Yeah, shares of Novo Nordisk plunging the most on record. The company reporting people treated with its experimental obesity drug, CagriSema, achieved a weight loss of 22.7% after 68 weeks. That's below the 25% weight loss Novo previously said the drug could deliver. Eli Lilly shares are getting a boost on the news, up more than 10%. And President-elect Donald Trump is threatening the European Union with tariffs if they don't increase their purchases of American oil and gas. The EU is already a major buyer of U.S. liquefied natural gas and has discussed purchasing more to deter tariffs. EU officials and member states have been bracing for a trade offensive ever since Trump's election victory last month. And Bitcoin is falling today. The price now lower by over 10% from its record high of $108,000 reached just this week. The downturn also impacting smaller tokens like Ether and Dogecoin. Some investors are opting to take profits and reduce exposure following the Federal Reserve's hawkish pivot on Wednesday. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Equity futures on the S&P, very much close to session lows. We're down by 0.8%. Up next, a looming government shutdown.
Very disappointing to us that all but 2 Democrats voted against aid to farmers and ranchers, against disaster relief, against all these bipartisan measures that had already been negotiated and decided upon.
Fun and games into the weekend. Anne-Marie down in Washington, D.C. has a whole lot more from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Three-day slide on the S&P 500. Make that day 4. Equity futures right now negative by 0.75% and poised for a second week of losses on the S&P. Yields have been grinding higher through the week. We pulled back 2 basis points now. The 10-year, 4.54. Under surveillance this morning, a looming government shutdown.
Very disappointing to us that all but 2 Democrats voted against aid to farmers and ranchers, against disaster relief, against all these bipartisan measures that had already been negotiated and decided upon. Again, the only difference on this legislation was that we would push the debt ceiling to January of 2027.
So here's the latest. This is how things stand. The Republican-led House rejecting a temporary funding plan backed by President-elect Donald Trump, setting the stage for a potential government shutdown, with government funding set to lapse tonight unless a new solution is found. Douglas Redeker of International Capital Strategies writing, there are real political issues around members of Congress and senators heading home for the holidays while the government is shut down. If the government shuts down, Social Security payments continue, but pay for federal workers, including military personnel, cannot be made. Doug joins us down in Washington alongside Anne-Marie. Anne-Marie, good morning.
Good morning, John. It looks like we are headed towards that shutdown at midnight this evening. Doug, is that correct? Are we going to be shutting down the government before the holidays?
Unless there's some strike out of the blue, which in the Trump era, or I should say the Musk-Trump era, could happen. But right now, I don't see any path to 218 and then to the Senate and then to the president's desk.
What are the options right now on the table?
Well, I mean, there's Plan A we know didn't work. Plan B didn't work. There is no Plan C. There's some talk, I think, about going back to Plan B. So the bill that didn't pass last night, going back and trying it again. I don't know why, the Einstein thing about, if lunacy is doing it, same thing and expecting a different result. I don't think you're going to get 38 Republicans to change their votes overnight on the same bill. So I don't know what the path is. I think the easiest path is probably just a very clean CR. Just say, let's just go home for the holidays. Let's deal with this in January. Let's at least keep the government open. But even that is, a very, very tough lift at this point.
But Hakeem Jeffries and the Democrats already negotiated that Plan A package. Would they go along with a clean CR?
I don't know. I think that if it were really clean, so it's literally the definition of a Washington kick the can down the road. You take all of the issues other than just continuing to keep the government operating, and you say, let's do this next year. I suppose theoretically that's better than, telling people that they're not going to get paid over the holidays. But, despite the Republicans' efforts, I do not see that the Democrats are getting blamed for this. This is purely in the camp of the Republicans.
So one of the biggest spanners that was thrown in the works was Donald Trump coming out and saying, you need to raise the debt ceiling. And he's now on the same side as some Democrats who for years have been calling to abolish the debt ceiling. Yesterday, I agree with President-elect Trump, says the senator from Massachusetts, Elizabeth Warren, that Congress should terminate the debt limit and never again govern by hostage-taking. Could you see under a Trump administration, maybe if it's not now, abolishing the debt limit?
I would love to see it. I think the debt limit is always this looming, ridiculous specter where, as we know, it's not about spending new money, it's about paying for things that you are borrowing to pay for things that you've already appropriated and spent. So it makes no sense to have the debt ceiling in our legal system, our governing system. Having said that, this is probably not the time to do it at the last minute, 11th hour, throw it in. It's unrelated to the CR as it was constructed. So could I see this happening in the next Congress under President Trump? Sure, they've raised it. It's now out there. But of course, in the past, these things have been quid pro quo. You don't get something for nothing in this town. And it's hard to see, even if you say I want it, that you're going to get it without giving something else up from the other side.
Where's the president on this issue? He's been very silent. The current president.
Okay. Yeah, he's very silent. A part of me yesterday was saying, my God, man, you're the president of the United States. You've got to weigh in. If the government actually shuts down, it's on your watch. And then part of me said, when your opposition is digging a hole, you let them keep digging. So I guess I'm sympathetic to the idea that Biden doesn't have the political capital to spend to actually contribute to this, which is a sad indictment of the presidency unto itself. But he's nowhere, and I guess he's going to sign whatever's put on his desk, and I think that's too bad, but that's the reality.
But we're talking about workers getting furloughed, VA benefits potentially not going out. At some point, does Biden need to step in?
Well, the question is, would it be helpful or not, right? This is right now all about the Republicans. As I said earlier, they're trying to indict the Democrats and say it was the Democrats' fault. It's a very heavy lift when 38 Republicans in the House voted against this to blame the Democrats for this. This is really the Republicans owning it. If Biden steps in, there's at least a chance that some of that political spill gets onto his watch. He's probably just saying, over to you.
Okay, so what does this mean for Speaker Johnson, January 3rd? Does he get the gavel back?
Yeah, I think the only reason Speaker Johnson gets the gavel back is because either no one else wants it or it's just fundamentally impossible to get the majority of the House Republicans, the entirety of the House Republicans, the majority of the House to vote for anyone else. So he got it the first time, not because he was everybody's first choice, but because they went through 1, 2, 3 different candidates, all of whom failed. He was the easiest guy to get through that didn't offend as many people as everybody else. That might be his ticket to success again in January.
Without a speaker, Congress cannot function, and Donald Trump cannot get through his agenda. Once they are able to function, though, I want to get your take on what are you telling clients on how they should think about next year, the sequencing of tariffs, immigration, and tax cuts?
Yeah, I think tax cuts, as we're seeing, are going to be hard. We know that there's a discussion about whether there would be one reconciliation bill or two. The entire fiscal policy is clearly something that doesn't have internal consensus within the Republican Party, much less across both houses, both parties. You might not need that in reconciliation, but even within the Republicans, that's hard. So I think taxes are going to be a later in the year kind of thing. I'm a believer that Trump, when he says something repeatedly, as he has on tariffs and immigration, that he means it. So I'm expecting early on, whether it's day one or week one, that there will be major moves on immigration and on tariffs. And I think the markets generally are underappreciating the risks of both of those.
So on tariffs, he truthed last night. I told the European Union that they must make up their tremendous deficit with the United States by the large-scale purchase of our oil and gas. Do you see this is how Trump is going to do deals? You buy this from us, we won't be as harsh when it comes to tariffs?
Yeah, well, that's the transactional Trump. And to some degree, the logic of what he just described is pretty strong, right? So we know that Europe has been long too reliant on Russia for its energy. Obviously, the war in Ukraine has made that a much harder lift. The U.S. has an enormous amount of LNG capacity that we can export. Of course, there are some logistical issues. You need to be able to import it. You need to have the terminals, and you need to have the processing. But let's just say this makes sense. Doing it as a threat, doing it saying either do this or we're going to throw tariffs on you, is probably not the way the Europeans are going to respond the most favorably. But the logic behind what he's saying is there, assuming the U.S. is a reliable supplier of LNG and other energy products. But this is not necessarily the method that the Europeans are going to respond to.
Right. Although Ursula von der Leyen did come out days after Donald Trump was elected and said maybe we'll buy more U.S. LNG. The issue is, of course, is Biden put a permit on LNG that is still in place. So is there even enough supply in the United States to get more there? This is going to take a while.
Yeah, so it's going to take a while, but there are a lot of excess LNG capacity in this country. Again, there's a logistical problem. There is, as you described, certain permitting issues. I'm not sure that we have as much as Europe needs to replace everything that it gets from everywhere else. But of course, nobody's going to replace everything with one source supplier anyway. So there is enough LNG that American suppliers could probably make investments if they knew they had long-term contracts, and Europe was going to agree to those long-term contracts. The problem with LNG is, to some people, it's a clean energy. To others, it's a not clean energy. And so longer term, are you boxing yourself in to buying an energy supply that is going to end up being unacceptable to the population of Europe, which is very green-focused?
But at the moment now, the United States is number one when it comes to LNG exports, imports into the European Union. Russia is number two. So I think the United States probably would say we should have a bigger chunk of that pie. Okay, so overnight he talked about tariffs with Europe. Previously, in the last few weeks, we heard Donald Trump talk about tariffs with Mexico, Canada, and China. Does he do all of these at the same time?
So Trump has used tariffs as both a means to an end and as an end. Right? So if they are an end unto themselves, that's when he talks about how you can raise, billions, trillions of dollars on the back of tariffs that are costless to Americans. Basically, his model in that way is we put tariffs on things, other countries pay it, and you, the American consumer, don't suffer any costs either through higher taxes or through higher prices. I don't believe any of that is true, but let's just say that's the way Trump thinks about it. The other is as a negotiating leverage tool. And that's where we are right now. The 25% on Canada and Mexico is stop immigration, stop the flow of fentanyl, and I'll rethink this threat about 25% tariffs. On China, we don't know what he means, because the 10% is a more modest tariff threat. China could probably absorb that relatively easily through, amongst other things, devaluing the renminbi. And the bigger threat out there is the 60% tariff that he's threatened against China. I think probably he'd love to sit down with President Xi, cut a big deal. I don't know what that would look like. President Xi is a different President Xi than he was 8 years ago. Trump may or may not fully appreciate that. So I think that there is, in Trump's mind, two conflicting uses of tariffs, as a means to an end and as an end unto itself. He can't do both.
Doug Redeker, thank you so much for your time. Jonathan, that was the managing partner of International Capital Strategies, Doug Redeker. As we await this potential shutdown, it looks like it's going to be happening this evening at midnight.
AMH, thank you for the update. We'll catch up with Anne-Marie in the next hour. Across a few things this morning, we are not going down quietly, are we, into the new year? Novo Nordisk getting hammered. We're down by more than 22%. An experimental obesity shot, losing less weight than predicted in a study. That stock's getting hammered. Eli Lilly, up in a pre-market by close to 11%. More on this story in just a moment. Coming up shortly, we'll also catch up with Jordan Rochester of Mizuho as Trump threatens the EU with tariffs.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Coming into Friday, a 3-day losing streak on the S&P 500, the longest losing streak going back to October. We're down again this morning. We're negative by 0.8%. We're down 1.3 on the NASDAQ. We're down 1.4 on the Russell. The small caps getting hammered. In the bond market, 2-year, 10-year, 30-year. We'll focus on the 10-year portion. Yields are down by 2 basis points, but they are up on the week by about double digits. The 10-year, 4.54. It's just not the shifting perception of the Federal Reserve and a drop of the easing bias. It's also the data, Lisa, this week. S&P Global PMI, retail sales, jobless claims, consumption numbers, GDP, data's been pretty good.
Which is now putting a renewed focus on inflation over employment, which is the reason why PCE, that key data point for inflation that the Fed tends to look at 8:30 today, might actually be pretty interesting. If it surprises to the upside, how much does this really re-emphasize just a hawkish tinge that we heard from the Fed?
Yields on a 10-year in a place we haven't seen since May, since late May. Let's turn to foreign exchange. Off the back of those moves that we've seen in the bond market, the dollar a whole lot stronger against the euro through the week, against the Japanese yen. Dollar yen has had a 2% move this week. We're back to 157. It is a third week of yen weakness and dollar strength.
And did you see the fact that Japanese inflation came in hotter than expected? You just start to wonder, why aren't they raising rates? They have inflation that's surprising to the upside. They have basically a currency issue where they want their yen to decline or to actually appreciate versus the dollar. Is it just simply that they want the tourists?
Possibly. You were one of them, weren't you? Or at least a family member was.
A family member was, but I would be an aspiring tourist.
I have to admit, I've checked out some of the hotels. I've had a little look.
This is my shocked face,
around
yeah.
160, I've been thinking about it.
Really?
Yeah,
okay.
Why not?
Just to experience?
Out of all the countries in Asia, Japan, I would love to go. And I've never been.
Everything's in its place. There are lots of
very
procedures.
Precise.
Exactly.
Culturally, everything's in order.
It's totally your speed.
It just feels like my kind of vibe.
I agree.
Dollar yen right now, 156.78. Let's get you some stories. Under surveillance this morning, shares of Novo Nordisk plunging the most on record. The company reporting people treated with a new experimental obesity drug lost 22.7% of their body weight. Sounds good, but it's below the 25% Novo previously expected. Eli Lilly shares getting a boost off the back of this news. Big rally there, Lisa. We're up by 9%.
So basically, you've got Eli Lilly versus Novo Nordisk in this war for weight loss drugs. Mounjaro is the one for Eli Lilly, and Novo Nordisk has theirs that now is raising questions about who can lose the most weight. It's sort of like, who is the biggest loser? This is sort of the debate between the two. This is a market that surged to some $24 billion just in 2023 alone, and it shows just how much is at stake. It also shows the dominance of some of the high flyers, because the Danish stock market is experiencing its worst day in a very long time, because that's where Novo Nordisk is based.
It's the second biggest weighting on the Stock 600, just behind ASML. The Stock 600 is lower by 1.7%. We'll stay on top of this story through this morning. Elsewhere, the U.S. government inching closer towards a shutdown. The Republican-led House rejecting a temporary funding plan backed by President-elect Donald Trump, with 38 Republicans voting against it. Government funding set to lapse tonight at midnight. Another big story. going into the weekend?
So there are a lot of questions here. First of all, as we were hearing from a number of different analysts, what's new about a government shutdown? We get them pretty much every time this comes up, which is the reason why President-elect Trump wants to actually do away with the debt ceiling. There is a question, though, about what this means for next year. If 38 Republicans are going to vote against this, if one of the hardliners, Chip Roy of Texas, says that this is asinine to just simply shorten the bill in pages, but still increase the deficit by $5 trillion and say you're making progress, it highlights a level of uncertainty around how exactly they're going to cut the deficit. Cutting the pages isn't enough.
I've seen a lot of criticism of the likes of Elon Musk, people coming out and saying Elon Musk is running the government. Hold up, let's take a big step back. We have a sitting president. His name's not Donald Trump. His name's not Elon Musk. Where is the President of the United States on this issue? Anne-Marie asked the question down in Washington moments ago, where is President Biden?
Yeah, basically, and Doug Redeker saying, what does he have to come into this, right? Is he going to be held responsible if the government shuts down, considering the fact that, for all intents and purposes, President-elect Donald Trump has already taken the mantle. He just isn't in the White House yet. And that sort of, it raises this question of, well, can this government function without actually a sitting president?
Anne-Marie joining us in about 45 minutes' time to try and answer that question, because I'm going to punt. President-elect Donald Trump threatening the European Union with tariffs if it doesn't buy more American oil and gas. The EU has already talked about purchasing more fuel from the United States, which is the world's largest producer of crude oil and the biggest exporter of LNG. Bloomberg's Ollie Crook joins us now out of Berlin. Ollie, we all remember Ursula von der Leyen coming out very quickly and saying, yes, give it to us. We're ready to buy it. Do you think actually this is a place we can make some deals?
Yeah, I think absolutely, John. I think there's both bad news and good news in this sort of message that we got here. I think the bad news is for European policymakers is getting back to this idea of the sort of truth social newswire being fired up 1:08 a.m. Eastern time. This comes out as sort of a bomb to the Europeans. The good news is that this is totally aligned with European interests, totally aligned with what Europe has been doing for the last 3 years. You look just at natural gas. They've tripled their volumes of imports from the United States since the invasion of Ukraine by Russia. We've got about 50% of all of the LNG that comes into Europe now is already coming from the United States. The other good news, John, is that we've had this sort of abstract idea of 10%, 20% tariffs to close the trade deficit between the United States and Europe. Now at least the Europeans know what Donald Trump wants, what can be done to sort of avoid this. And just to tie in another story that we got significantly over the last 24 hours, there is this Ukraine-Russia gas transit deal. There's still about 50 billion cubic meters of gas that flows from Russia into Europe. That deal is now dead. That is a sort of deficit of 15 billion cubic meters. That's about 10% of what Russia used to send before the war. That is another thing that could be closed by this gap. And just a final point on this, John, I think this actually maybe one of the most interesting parts about this. He says he told the European Union. Who did he tell? Who is Donald Trump in contact with? Is it Viktor Orban? Is it Olaf Scholz? Is it Ursula von der Leyen? Who is going to be the sort of power broker in this new sort of geopolitical architecture? That, for me, is one of the main questions here.
Ollie, forgive me, but when I read this from Donald Trump, I thought to myself, isn't this what everyone kind of wants? That there was, except for maybe Joe Biden, when he put a pause on some of the licensing for LNG exports to Europe. Europe wants to export more LNG from the U.S. U.S. producers want to export more to them. Does this really have to be sort of, I'm going to tariff you if you don't eat your candy?
Yeah, again, I think the way that Will Kennedy, our sort of editor on energy, put it is that this is sort of pushing an open door, right? This is something that basically everybody is sort of aligned on, everybody wants to do. I think that, from that perspective, I think that there's going to be basically very little resistance here. This is going to be easy wins for a number of governments. They need to secure that sort of energy pipeline. There's no way that they're going to continue to get some of this Russian gas. There was all these discussions about basically could that Russian gas go through Azerbaijan, then Azerbaijan sells its gas into Europe. Basically, all of those concepts are dead. So again, you still have another deficit that needs to be plugged, and it is plugged most easily, most conveniently, and most sort of conveniently from a geopolitical standpoint now to gain favor with Donald Trump by buying more American.
The Italian flag in the background suits you, Ollie. Ollie in Brussels, by the way, not in Berlin. A change of scenery for him going into the holiday period, Lisa.
That's immediately where your eyes go. Just the Italian.
Beautiful thing.
Yeah, it was great.
Just trigger some patriotism.
That was the reason I saw him. Please zoom in, just frame right there, and then that was the only thing. I know you orchestrate these things.
Jordan Rochester of Mizzou joins us now for more. Not on that. on this. The EU will be hoping this is the same political theatre as 2018. I would argue that hope is not a plan, and LNG imports won't address the size of the US trade deficit, but it's the best the EU have got to work with. Jordan, welcome to the programme, sir. Jordan, news or noise when you read that statement?
It's news, because if you think about it, John, and Merry Christmas, by the way, good to see you. If you think about it, we've had Trump come in, winning the election. He targeted Canada, Mexico, and China. And I noted to clients, mysteriously absent on the rest of the world, Europe, Japan, the rest of Asia. And he started to pick them off one by one as time has gone on. We've had India this week, and now we've had the EU today. And as I put in the note to clients, the tricky thing is if he's serious. If he's serious, the EU can definitely buy more LNG, but the problem is they won't at all be able to plug the deficit with the US just from LNG alone. Oil might help as well, but I think oil's pretty much maxed out too. If you look at the LNG purchases the EU has made from the US, it's already half of EU LNG imports. It's a fantastic achievement. And the exports of LNG from the US have been ramping up a lot over the past 5 years, but they can't double in the space of this 1 year period, I would say. And they're annualizing around $26 billion a year in what the EU buys from the US, if it was to take all American LNG exports. So it's just really difficult for the maths to add up. So in answer to your question, it's news if he's serious, because the EU, A, won't be able to negotiate a deal on behalf of other members. Juncker didn't have that power, neither does Ursula von der Leyen now. And what Juncker did in 2018 was a political charade, really. It was a memorandum of understanding. It wasn't a trade deal. It was just a sort of loosely worded statement saying we'll buy more LNG and soybeans. Well, they have. And Trump's still complaining. The deficit has gotten wider since the EU has actually already increased their LNG purchases. So if he's serious, the maths doesn't add up and tariffs come into place. But I think perhaps, John, he's giving them a way out to do the same they did in 2018 with a memorandum of understanding, and maybe he avoids tariffing Europe to begin with. But it's all down to human decision at the end of the day, John.
Jordan, let's take this story and push it through foreign exchange, as we often do. We've already had a 5% move on euro-dollar, weaker euro through this year so far. Is this another reason, in a long list of reasons, to keep selling the euro?
Yeah, there's a long list of reasons to keep selling the euro. It's like cats and dogs. You've got what's going on with the tariff situation. You've got what's going on with European macro. The industrial recession in Germany just keeps getting worse. In the short term, we've had services strength in Europe keep us in doubt about how far the ECB can cut rates. But I think the services sector will turn lower next year. It's just so difficult for services to do well if you're laying off your manufacturing employees, as Germany and others are doing in Europe right now. So we've got 101, so near parity in euro, John. But the key message from my side, John, is that's a view into January the 20th. And I think the inauguration is an event risk in itself. It could be a day where we get a list of executive orders in the afternoon from Donald Trump. If tariffs do not feature in that list, if he doesn't start a sort of investigation into raising tariffs on others, it could be a buy the rumor, sell the fat moment. And that's why I think 101, we price in maximum pain. And then if it goes more smoothly, if there's not a significant tariff hike on day one of his presidency, perhaps it's mean reversion. And this market likes to mean revert, and the dollar sells off from there.
In the past, the dollar has sort of had a self-correcting mechanism where if it gets too strong, things start to break, and then suddenly weakness takes over and there is this normalization. At what point do you see that risk coming into play?
Indeed, it ties to the FOMC response function. Typically, you have a big sell-off in equities. The FOMC kind of rides it out for a bit, but when you have a 10% drawdown, they tend to circle the wagons and reverse course. I think that could be the case. It feels a lot like 2018 to me, Lisa. Remember 2018? We had a pretty hawkish Fed. We had a 10% sell-off in the S&P 500, and then we got to January, and Powell changed his sort of mood music quite quickly in just public statements, and we had most of that sell-off come back in the first part of January 2019. So we could be in for a case of that sort of story. I'm not calling for a 10% drawdown, but that's the sort of pain threshold where you get the Fed members responding and perhaps changing their language. But it's really difficult because the macro data supports a much more hawkish Fed. We've long had a 4% terminal as our view at Mizuho before Trump won the election. A lot of people joined us in that race to 4% once Trump was elected. But we're now pricing that pretty much perfectly in the rates curve. So it could be the case, Lisa. I think the risk reward is we actually price in a little bit more cuts than what's now in the market. I think we should be at least pricing a cut by March or June. There's about one cut by June, but March is around 50-50. And so we should see some curve steepening on the back of it. 2s, 10s looks really interesting here.
We've talked about two different issues, whether it's the tariffs and just the Donald Trump risk to potentially a weaker euro, stronger dollar, and then there's the Fed response mechanism. Which do you think is in the driver's seat?
Well, I think the Trump trade is in the driver's seat for everything in January. It all boils down to that. And then once we know what's happening with tariffs, it's done. It's essentially the information is in the market, and then we go back to following what the inflation data says, what the GDP data says. And it's just difficult for the Fed to be dovish when you've got GDP at 3%, and they're now casting even a bit higher than that. You've got inflation re-accelerating on the month-on-month numbers, and tying this into the LNG story, have a look at natural gas prices at Henry Hub. They're at the highs of the month. They're rising in a fashion that could bring energy services CPI as a problem next year for the Fed. So altogether, Trump's in the driving seat trying to push up LNG exports, pushes up domestic prices. It's inflationary as a policy. And then you've got the situation with tariffs, which of course are inflationary. I suspect they'll stagger the tariffs, though, over a year to try and reduce the knee-jerk reaction from firms having to raise prices as soon as the news is out. And we're hoping to see, or we're probably going to see, FX depreciation in China and all those other currencies such as the euro to help offset the impact of any tariffs if they come in. So if you have the 60% tariff on China, that's a huge piece of news. That's definitely in the driving seat right now.
Last question then, Jordan. Year to date, if I go on the screen on the Bloomberg terminal and have a look at where things are at the moment, everything in G10 is weaker against the US dollar, including the Japanese yen with a 10% move. When I do the same thing at the end of 2025, is that screen going to look any different?
Good question. I think it will look different. As I say, I think we actually get dollar weakness by the end of next year, but it's dollar up for the next quarter and then down from Q2 onwards. I think you will see the yen strength come back in as we're still in a rate hiking cycle from the Bank of Japan, and you will see the economic data improve. I'm an optimist, John, for the second half of next year. We've got all this monetary easing. We've got the potential for China fiscal stimulus in Q2. We should be seeing a weaker dollar when that happens. So we've got euro bouncing back to 105. But it's such a mild rally. I'd focus more on the sort of story for the dollar right here and now.
Got it. Jordan, Merry Christmas, sir. Thanks for everything this year. Appreciate it. Thank you, buddy. Jordan Rochester there of Mizuho, looking for further dollar strength at the start of 2025, and then the weakness starts to kick in. You start to look for the policy shifts in places like China and beyond.
So Hotel 2 Nishinotoyan Kyoto has space for you in February if you want to take advantage of this window.
What's the hotel like?
It is beautiful looking.
Yeah,
wow.
good food?
The food looks amazing. It looks like, actually, it has a good variety of not just Japanese food. Look, I'm being kidding.
You're being sincere?
Well, I'm saying that basically if it's going to go to 160 and then it's going to be the other way around.
Yeah, make a move now.
I think that's the reason why people have all been traveling to Japan.
That's where TK is at the moment.
Is it?
Yeah.
Can you imagine
Took
him?
a long weekend after the Federal Reserve decision.
He definitely seems like he would enjoy taking his shoes off, sitting down, cross-legged at a
He's
table.
a sushi kind of guy. Loves it. Equities right now on the S&P, negative by 0.8% on the S&P 500. With your Bloomberg brief, let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. President Joe Biden is expected to announce new plans to cancel student debt for about 55,000 public sector workers, totaling more than $4 billion in forgiven loans. This move brings the total number of individuals who have received relief under the Biden administration to nearly 5 million, with a total of $180 billion forgiven. Easing the burden of student debt was a key promise of his 2020 campaign. Meanwhile, China's bond market is rallying on expectations of policy easing in the country and demand for safe haven assets. One-year bond yields are now trading at their lowest level in over 2 decades at about 0.9%. You have to go all the way back to 2009 to see these levels. The stars seem to be aligning for this year's rally to extend well into 2025. Amid speculation, China will make deep cuts to interest rates to bolster its economy against the threat of more U.S. tariffs. And a big win for Boeing. The plane maker has secured a $36 billion order from Turkey's Pegasus Airlines. The carrier placed orders for 100 not yet certified 737 MAX 10 models, with options to order another 100 more. It will begin receiving the jets in 2028. While it's a big win for Boeing, it's a major blow to its rival Airbus, which was the previously preferred choice for the Turkish airline. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes' time. Up next on the program, a FedEx spin-off.
FedEx Freight is the most profitable part, that they've got. It's small, but it's growing. Generally, this is a good business from a macro point of view. But FedEx, as a bigger story, has always been about something other than the economy.
The latest on that company up next on a program live from New York City. You're watching Bloomberg TV.
About artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Whatever happened to that Santa rally? It's breaking down right now. We're negative by 0.9% on the S&P 500. 3 days of losses into Friday. Could become day 4. In the bond market, attracting just a little bit of a bid. Yields are lower by 2 basis points. The 10-year 4.54. We're at levels we haven't seen, Lisa, since May, following the Federal Reserve and better than anticipated economic data in America.
It raises the question of how much was this actually a shift from the Federal Reserve and how much was this just sort of an acceptance that the higher inflation that we've been seeing truly is higher inflation that could affect how much the Fed is willing to cut next year.
Under surveillance this morning, one stock in particular, a FedEx spin-off.
FedEx Freight is the most profitable part, that they've got. It's small, but it's growing. They've got some unique aspects, particularly on the southern border in the U.S., where they do well. And generally, this is a good business from a macro point of view. But FedEx, is a bigger story. It's always been about something other than the economy, or at least for the last few years.
So here's the latest this morning. FedEx spinning off its freight division into a separate publicly traded company. The Wells Fargo analyst Chris Weatherby writing, we believe a FedEx freight spin into a standalone company will be viewed positively in the near term. Chris joins us now for more. Chris, welcome to the program, sir. Why is it the right time to execute this move?
Well, I think they've been thinking about the spin of their freight business for the last 6 months or so. But when you look at the comparable multiples of other LTL companies in the market, they trade at a significant premium to what FedEx does. And I think by spinning this out as a standalone, they're going to be able to tap into that relative value difference, be able to see some upside for the business, which is a smaller piece of their business, only 10% of revenue, but ultimately has a significantly better margin than the RemainCo. So I think getting that access to that better multiple certainly provides a pretty big lift from a sum of the parts perspective.
Chris, can you just give us a sense of where FedEx is in its turnaround plan? Its shares are down considerably so far this year. There's been this real underperformance as they lose business to the Postal Service as well as other providers. How far along are they?
So we're technically in year 2, so about halfway through the second year of their 2-year drive program. So we've made some progress so far, about $1.8 billion of potential savings in the first year. They're looking for $2.2 billion in this fiscal year. And like I said, they're about halfway through that. They seem to be achieving it. That being said, as you noted, there are some headwinds in the market that they're facing. So we're not seeing that benefit come through as net benefit to results. So I think they are making some decent strides. We saw that in the fiscal second quarter. Their Express segment, which people had been worried about, did post better results than expected. It was the freight segment, actually, ironically, that was a little bit more challenged in the second quarter, but it does appear that they are making some results. So they're making some progress here. They are, I think, affecting change where they have the ability to, but they are fighting through what is still a very challenging environment for people like FedEx and UPS who are moving freight around the world.
Chris, it's sort of shocking when I hear they're challenged by a weak consumer when so many other companies are talking about the strong U.S. consumer. Can you square that circle for me?
Yeah, I think there's absolutely some strength in the consumer freight flows that we're watching on a regular basis. You know, imports into the country, containerized imports have been up double digits for many of the last months of 2024, as we've seen a restocking event and a fairly resilient consumer from a spending perspective as well. I think the reason why FedEx has struggled to some degree with consumers is really the e-commerce side of it. So both FedEx and UPS don't really have as much access to the parts of e-com that are growing the most rapidly. So folks like Amazon, we've even seen some of the lower priced discount Chinese e-com players like Temu and Shein also growing very rapidly. And FedEx just frankly doesn't have access to that volume growth. So Amazon is not a customer, and they're limited in some of those other very high growth categories. So you're left with sort of the rest of e-com, which is growing faster, generally speaking, than the broader economy, but is limited to some extent. So I think that's why you're seeing this discrepancy, because as I noted, consumer demand, generally speaking, has been surprisingly good in 2024.
FedEx this morning up in a pre-market by a little more than 9%. Chris, appreciate your time, sir, going into year-end. Chris Weatherby there of Wells Fargo on the latest spin-off effort from FedEx. That stock again up by more than 9%. If you are just joining us, welcome. Equity's getting hammered right now. Ever since that Federal Reserve news conference, as soon as it started and Chairman Powell was asked about the decision, why